a long-term, equilibrium R star. So I wouldn't tie those two features together. And I think it's very important to separate them, in fact.
So, Alan, let's just build on that. And let's start here, because you've done some tremendous research on this in the last couple of months. I've been reading through it all. You talked about how unusual it is to have nominal growth as high as it is right now and to have yields and rates where they are at the moment too. Just how unusual is that, Alan?
There's no historical precedent for nominal GDP running at, say, 11%, Q4 on Q4, which is what we probably will get with the GDP numbers, and a 5-year tracking, where it is currently, or all rates, the rate structure sub 2% in the treasury market. So there really is nothing even close to this, John, which then also begs some very important questions, because I think a lot of people are going to say, well, wait a minute, the yield curve, which has been such a reliable signal, is going to invert shortly, and watch out, guys, in 18 months to 2 years, you're going to have a recession. I think that yield curve in general is not giving a pure signal, or past historical precedent is not accurate either.
Does it tell you something about how much work this Fed will need to do? Alan, this goes back to the conversation you were having with Tom just a moment ago. There is a belief that we stop at 175, that the Fed funds rate will peak out there. And I sense that you're pushing back against that in just the comments you had a couple of minutes ago, Alan. What kind of number have you got in mind?
Yeah, no, I push back against it, pretty strongly. So, think in terms of a real funds rate, and historically a real funds rate peak would be nearer, say, 3%. In the last cycle, and we're always fighting the last war, right? We're always thinking in terms of the last cycle, because that's freshest in our memories. The real funds rate went up to about 0. So even then, if you just took a 0 real funds rate, you would have, certainly a nominal funds rate of, say, 2.5%. That would be almost a minimum. Now, I think the last cycle, you didn't have an inflation problem at all. I think core inflation, this core PCE, was just above 2%. So the Fed wasn't fighting inflation. So in this cycle, you're fighting inflation. So there's even more reason why you should actually have a much higher terminal rate.
Given that, and given the fact that the yield curve is cause for a lot of people's concern should it continue to flatten, do you think that the market is underestimating a discussion about balance sheet roll-off in the nearer term, as that would likely affect the long end of the yield curve more quickly?
But I think the market's underestimating perhaps this sort of general story that relates to taper. They're not treating taper as any sort of tightening. And I think it is some tightening, because if you look at the flow of funds and you look at the role the Fed has played in financing the public sector deficit, it has been absolutely critical. So, just as that taper gets accelerated and the Fed's role diminishes, I think you will see term premiums start to pick up. But I think the more important story from the bond market is less the term premium side than the risk neutral rate. I think the risk neutral rate is the thing that's going to have to go up, substantially. That risk neutral rate is, essentially the expected funds rate.
Given the fact that you seem to think that the signal coming from the bond market is highly messy at best, and that it is not accurate in terms of a portrayal of the overall economy, do you think that Jack Ablin over at Crescent Capital came on earlier and said that the bond market is smart money is no longer correct, that the bond market no longer can be a signal for equities in the same way that it once was?
Yeah, I think it is problematic. I think what you've had, I think people underestimate this, is and you don't see Fed officials talk about this sufficiently, is this drop of helicopter money. 25% of GDP's worth of M2 balances dropped into the system, that essentially creating bubble-like conditions in all asset classes, inclusive of the bond market. This liquidity is going everywhere. It's going into Bitcoin, it's going to equities, but it's also going into the bond market. Some people talk about it as excess savings, but I prefer to talk about it as excess liquidity, because I want to say the Fed's responsible for some of this. This is not just household savings per se. Policymakers are actually responsible for this. And this was prudent policy in March of 2020, but it's not prudent policy now, in November, December 2021.
Alan, Mr. Erdogan at one point wanted to look south and west across the new Turkish reach. That has been shattered over the last 5, 6, 8 years, and shattered today with new weakness in Turkish lira out to 14.74. You and I spent a starry evening in Dubai waxing philosophical about emerging markets. Is that the great unknown for 2022? Is all this Jerome Powell chat and what it means for emerging markets who do not have the degrees of freedom that America has?
Yeah, I think the emerging market story is complicated. I think there's a sense that if we get through the early stages of Fed tightening, and particularly if the Fed does what the market expects, then the emerging market complex can trade better in the second half of 2022. I think in the end, it's still going to come around to this story about the terminal rate. If the terminal rate is substantially higher than what the market's priced in, then EM is still going to have a hard time of it.
Alan, just wonderful, as always, and good to hear from you, sir. Alan Ruskin at Deutsche Bank. Tom, one of those conversations that when I get home a little bit later this afternoon, I'll have to lift them back to. Just absolutely brilliant about just how much work this Fed needs to do, given the economic backdrop right now.
We talk about glide paths. Peter Orszag, I give great credit for this idea of glide paths. And there's multiple glide paths, John, that any monetary policy leader has, and they glide out to this so-called terminal rate. My distinction is it's about economic growth at the end of the day, and the machine has worked in America. Maybe it's a fiscal stimulus, maybe it's not. But what's so unique about this Fed meeting, John, is how alone America is in relative prosperity.
One question I think for a lot of people going to this Fed news conference, this Fed meeting, Lisa, is just where the hawkish surprise comes from. We've been talking about the dot plot making a shift higher. We've been talking about the taper accelerating much more so. Where does the hawkish surprise come from?
Look, Alan Ruskin and Bill Dudley both pointing to the longer-term expectations, the dot plot, in terms of whether they'll shift up the longer-term expectations. But what Alan Ruskin just said there about basically the bond market not any longer being the smart money because of how distorted it's become because of monetary policy is massive. The implications are massive for a Wall Street hinged on models.
We've got the former fixed income guy saying it's the smart money and the FX guy saying it's not.
It's a war,
We'll get you a different opinion a little bit later. Futures are down 4, let's call it down 5, negative 0.1% on this Fed decision day right here on Bloomberg.
With the first word news, I'm Rishika Gupta. The U.S. death toll from the coronavirus pandemic has now passed 800,000. That's according to data compiled by Johns Hopkins University. More than 200,000 of those deaths occurred after vaccines became widely available last spring. The U.S. has the highest reported death toll of any country. One of the most widely used vaccines in the world, China's Sinovac, doesn't provide enough antibodies to neutralize the Omicron variant. That's according to researchers in Hong Kong. Those findings may have sweeping consequences for millions of people who are relying on the shot to protect them against COVID. The House has voted to hold former President Trump's last chief of staff in contempt of Congress. Mark Meadows has refused to testify in the Capitol insurrection investigation. He's turned over emails and other records, but Meadows cited executive privilege in refusing to appear before lawmakers. And Congress is seeking to increase pressure on China for its treatment of Muslim Uyghurs. The House has passed a bill that would ban goods from the country's Xinjiang region unless companies can prove they were not made with Uyghur forced labor. China has denied the allegations. There's a sign that retailers are still struggling to fully recover from the pandemic. The parent of Zara, Inditex, posted earnings that missed estimates. Meanwhile, H&M reported revenue that was less than expected. The chain says it will increase discounts in the fourth quarter to reduce its inventory. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is really about reaching the unvaccinated, and many policymakers have given up, so they continue to boost the people that are already vaccinated, but that's of much less value than getting first and second doses into people. And I think that they've recalibrated to focus on cases because they've given up on the unvaccinated, and I think we can't give up on the unvaccinated.
Amish Adalja there, the Johns Hopkins Center for Health Security senior scholar from New York City this morning. Good morning. Lisa Abramowitz, Tom Keene and Jonathan Ferro on this Fed decision day. 2 days of losses, Monday into Tuesday into Wednesday. It could become 3. We're negative 0.1%. A lot of work to do to get to the end of this session. We're down about 4 points on the S&P. Elsewhere in the bond market, Tom, 144.28 on 10s. Going into the big one later this afternoon.
If you are fancy, John, and you go to India, you stay at the Oberoi and say you went to India. That's in Mumbai, and it's a fancy 6-star hotel. That's the one John goes to when he goes to India. Bhakti Ansari does something different. She is world acclaimed on going where others don't. And Bhakti, I'm not going to pronounce the names because I'll just kill it, but we are thrilled to have you here as you were north of the Ganges, somewhere south of Kathmandu. What does the real India look like in this pandemic?
So the real India looks like real rural America. You know, there's fear, high rates of unvaccinated individuals, patients coming to the hospital confused, scared, and there's a real fear after what India lived through during the second surge that it's all about to start again. And they're getting ready and getting prepared to be able to fight the new variant.
So you get a cup of coffee with the leadership at Pfizer, at Moderna. You and Dr. Adalja sit down with them and say, look, here's the reality of helping the rich and poor of the unvaccinated. What is the plan to get the unvaccinated vaccinated?
Twofold. Globally, the issue still is supply chain. And so like improving supply chain, providing vaccines with adequate shelf life, ensuring that those vaccines reach that last mile, that last village is really key, and that involves partnerships with government. Locally and in other higher resource settings, the issues are really around anti-vaccine sentiment and how do we combat anti-vaccine sentiment. And I don't think any of us thought that we would be having this conversation 20 months into the pandemic.
Dr. Ansari, you said that India is getting prepared for the Omicron variant to spread, akin to what we saw in the second wave, which was terrifying by all accounts, by the images that we saw, and I'm sure by the aftermath that you witnessed. What does that look like with the Omicron variant based on the initial evidence that we have?
So luckily for us, what we're seeing from South Africa is while reinfection is common, hospitalization is common, less patients are requiring oxygen. Now, what we saw in the second surge in India was that a lot of patients died from critical hypoxia and lack of oxygen access. Oxygen access in India has been significantly strengthened, but there are other policies in place. They're improving border control, improving same-day rapid testing prior to travel, and all of these innovations will help, the spread of the virus in going to those rural, underserved areas.
One confusion that a lot of people have, myself included, is how much less virulent the Omicron variant is. We don't have concrete data showing that. But the real issue here is, when does this move from a virus that we need to counter and social distance for and mask and vaccinate repeatedly versus a common cold, versus something that you're going to get every once in a while. It's not going to be fun, but you get over it. You live, you move on.
So I really try to think about, what does it mean for a virus to be endemic? So scientifically, an endemic virus is one that has predictable variations, seasonal variations like the common cold, that its impact on the health system is manageable and bearable and acceptable to society. And the third is that the number of people infecting another person is one. And we're not there with COVID. We know that these surges can have catastrophic consequences on the health system. We're already seeing in the United States several hospitals claim they have no more ED beds, no more ICU beds, and our resources are outstripped. So I think what my concern is, by calling this endemic, that there'll be a complacency that'll set in, which I think is unnecessary, because there's still deaths that need to be avoided in our future.
Based on the trajectory of the pandemic, when will we get to that point, Dr. Ansari?
I think it's soon. We are now expanding vaccines. Vaccine uptake has improved in the United States in the recent weeks. We are really expecting the youngest in our society, the under fives, to have access to vaccines very soon. And as the virus continues to evolve, we do think while transmissibility will increase, the virulence is unlikely to continue to increase. So I'm really saying, like, next Christmas, we will not be having this conversation. I will not be on the show, I hope.
Oh, no.
I heard that 12 months ago, Tom.
Yeah. We do scientific research here, and the needle goes when you're on. So, no, you'll be we expect you to be talking about the 2-year yield in 2 years. Bhakti Ansari of Johns Hopkins, thank you so much.
Doctor, thank you.
Go away.
Tom, China, a big issue here as well. The data overnight was disappointing. There's a concern about supply chains.
Yeah.
Just look at the data coming from initial lab findings on the Chinese vaccine. It doesn't provide sufficient antibodies in 2 doses to neutralize the Omicron variant, and boosters will likely be needed to improve protection. And we know the threshold, the tolerance level of the Chinese Communist Party, Tom, and local authorities is very, very different to what we see in the West.
Is this a dismal decade for the Chinese? You look at the different overlay of stories, John, into the science of this. I think you're dead on. I think there's not been nearly enough talk of adults like Dr. Ansari or amateurs like us about the variance of all these different shots, pills, things to come. Some work, some don't.
I was saying the economy, Tom, there's been a shift in the last week. Lisa, just in terms of expectations, the conversation has really shifted around China. Yeah. The belief that we could have a stimulus push here.
That basically the People's Bank of China is not willing to tolerate some of the weakness that they're seeing, especially as it hits the property sector harder and harder. There's a company, a property developer, that ran into problems that's actually getting more concerned than the Evergrande situation, not because it's bigger, it's much smaller, but because it's highly rated. There is a sign of contagion that continues to be ongoing, and their hands kind of getting called.
And we know COVID-0 is basically essentially unachievable.
Exactly.
Yet they seem to be be the last man standing when it comes to that effort, Lisa?
Well, a lot of people saying that how much does this have to do with the Beijing Olympics? How does it have to do with how they want to message things ahead of a number of key Communist Party meetings? And after that, they might relax. But what's the damage in the meantime? And what are the tools that they are willing to use to really counter that?
And what does that mean for your assessment of supply chain improvement through 2022? We'll talk about that in the next hour. Your market right now, just to reset, get you ready this Wednesday morning.
Me, John.
Good morning, Tom. We're down about 2 or 3 points on the S&P. Can we go back a few decades and hit reset, Tom?
Never.
Before it's too late. 144.45 on 10s. I think it was the 40s that set the trajectory for TK.
Yeah.
Is the music playing?
Can I tell you about retail sales?
Of course you can, Tom. 8:30
So
Eastern.
Afterthought is like totally into like influencers, if that's how you pronounce it. She goes to me, I need a black sweatshirt that says Celine on it. I'm like, some guy with it. So I'm outside Celine yesterday and I can't get in, John. Yeah. And the door opens. A police officer opens the door and there's Tabitha. I go, Tabitha, how much is the Celine hoodie? And she told us the number.
Okay.
The police officer fainted.
This is how Tom gets me back. Tom knows that there's a certain someone with a Celine hoodie in his wardrobe.
The police officer hit the ground.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg Bloomberg.com webinars.
The concern is, are potential banks going to withdraw accommodation too quickly?
The Fed has turned really hawkish. They're getting really aggressive.
You may very well be lifting off, even though you might not think you're at maximum employment.
The fact that they believe that neutral is quite low means that they don't have as far to go.
How high can they go in terms of rate hikes and not invert the yield curve?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I just want everyone to know that I am being bullied in the commercial break.
Oh, you're being
right, just
bullied.
so everyone knows.
Yeah.
From New York City, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. We're down about 2 on the S&P, Tom. Your Fed decision, hours away.
Well, the VIX 22 shows that, and of course the bond market here has been, John, you mentioned it nicely, that it's just been there and churning, and Alan Ruskin talks about the terminal rate. John, there's a backstory here for 2022, which are the EM challenges Mr. Ruskin talked about, and you see it in Turkish lira, John. I rarely editorialize. I'm doing it right now. Short lira on a log chart is absolutely textbook. John, the trend there is horrific.
Getting close to 15, and what a move it's been. You bring up EM, Tom. We've had the hikes from EM this year in a big, big way outside of Turkey, of course. I'm looking to Brazil and elsewhere. And looking ahead to next year, Tom, that's the question, isn't it? Is it DM's term?
They are defending their currencies against the shocks of pandemic, true, the shocks of trade, true, open economies, etc. But more than anything, John, the shock of what we're going to see this afternoon at 2 o'clock, they have to adapt to Jerome Powell.
The focus shifting back towards the Federal Reserve, Lisa. The expectations as follows: an acceleration of the taper, 2 dots showing hikes next year, or rather more dots than that. You know where I'm going with this. 2 hikes next year, 3 hikes in 23. Where does the surprise come from?
And I think that's a great question, especially as some people throw the balance sheet on the table. How concerned are they about inflation at a time when their other developed market peers are not as concerned? I do wonder, I was kind of smiling when you talked about emerging markets and then moving to developed markets. So what would you call the Bank of England? EM or DM?
Oh, the currency certainly behaved like an EM currency at times since Brexit over the last several years. I think most people would still assume, I think Governor Bailey would refer to his central bank as a developed market central bank.
Sure, but I say that because they have to face off with a rate hiking decision after an inflation print, the fastest 3-month inflation increase in the region going back ever. And you're seeing right now this idea that perhaps they can push off a rate hike because of what's going on with Omicron. It really creates a tension for them that's similar to the emerging markets.
I promised you a phoner this morning,
I know.
Didn't I?
Yes, you did.
I promised you a phoner.
Absolutely.
Tomorrow morning, if they hike interest rates, I'll get on the phone and say I was wrong.
With video.
And that the year ends tomorrow and not today.
In a Celine
Futures
sweatshirt.
Unchanged on the S&P. Can we let the Celine sweatshirt go? Come on. I don't insult you guys for what you're wearing. I think Tom looks beautiful in a bow tie. I think you look great too. What's wrong with the Celine sweatshirt?
In all honesty, I look like a hobo when I walk out of here, so you can make fun of me.
Thank you.
Okay.
Futures unchanged on the S&P. Your bond market unchanged too at 144.28. Just a bit of tension in the room going into a Fed decision, Tom, a little bit later.
Tension in the room, there'll be tension there for the Eccles building as well. I mean, there is a tension in this dynamic of taper and rate rise as well. And John, we've got to remember our wide set of experts really disagree.
We're going to catch up with an equity market view in just a moment, Lisa. That equity market is still pretty close to all-time highs.
Which is really shocking considering the idea here of a potential hawkish surprise from the Federal Reserve. Is it an equity market that is accepting the risk and looking past it to earnings, or is it basically just not waking up to the reality of a new paradigm at the Federal Reserve? 8:30 a.m. we get U.S. November retail sales as well as December Empire manufacturing data. The interesting thing to me is that retail sales does not parse out what is organic increase in sales versus inflation. It does not strip out the 6.8% increase in the CPI that we've seen year over year. How does that factor in when we're trying to figure out whether consumers are losing some of their momentum with respect to how much they're willing to buy? At 2 p.m., we get that FOMC statement followed by a Jay Powell press conference at 2:30. Where is the surprise going to come from, John? A very good question that you continue to ask. And really, a lot of people are wondering whether they will talk about the balance sheet, not only the acceleration of the tapering, trying to end end it perhaps in March or April, but when will they start to allow the bonds to roll off? And today we will ask that question and talk about all of the issues that the Fed is facing with Harvard professor Kenneth Rogoff, as well as ex-New York Fed President Bill Dudley, ex-Philly Fed President Charles Plosser, ex-Fed Vice Chair Alan Blinder, all of whom I'm very curious to hear from because former Fed officials have taken a starkly different tone, John, than current ones and been much more vociferous about saying the Fed needs to act and they need to act soon.
Look what you've started with this Celine hoodie stuff. Bloomberg Terminal subscriber. Is it crop top? I had to point out they do a men's range, Tom. They do a men's range.
What's a range?
A range of clothes available for the man.
I didn't know that.
And Celine. Your equity market
my
down
idea
to...
of fashion forward is LLP, so, you know.
Let me move on. We're negative about 0.1%, not even. Joining us on the equity market, Steve Cheverone, portfolio manager at Federated Hermes.
Not wearing Celine.
Steve, when does Fed policy start to become a problem for this equity market that's very close to all-time highs?
Well, John, before I go there, should I change and throw a hoodie on?
Maybe. Maybe. Or you can rock Patagonia, Steve. That works too.
So in all seriousness, I think in a weird irony, the market is welcoming the Fed to move. And I think that's why you see the equity market at near all-time highs, despite the fact that bond yields are where they are. I think what the concern in the marketplace is that by having waited this long, the Fed is already at risk of having to overreact. And I think that's where Powell's going to try to reset the narrative here, hopefully starting today, by trying to make the argument that by accelerating taper and starting that rate hike cycle earlier, he can proceed at a measured pace. If he threads that needle, I think you can see the yield curve even steepen a little bit. But that's a tough sell because credibility is not abundant right now. So I think that's the task before him, and it's not an easy one.
Steve, I want to talk about the great bull market we've had since Christmas Eve of 2018. Ben Laidler, your entire team at Federated have participated with us. Folks, these are stunning numbers of a great bull market in pandemic. SPX up 108%, Dow up less, NASDAQ 100, tech laden up 177%. Thank you, Mr. Cook. Steve, what is the courage it takes to be in the market to enjoy 18, 19, 20, and all of 21?
Yeah, I think, and you're right, Tom, it's not always easy. And there's certainly times where you doubt yourself. I think you've got to be able to take a longer term view and not get lost in the most recent headline. COVID's a perfect example here. You've had waves that have come, you've had, positive headlines, negative headlines. If you're just following the next headline, you get lost at sea. So you have to have a framework. For example, for us, we've used an earthquake framework. The initial shock is terrible, it's deadly, it's damaging. The ground does shake again, and those are dangerous, but they're aftershocks. And each aftershock, tends to be a little less severe. And you've got to be able to take that longer term view. And so far that's served us well. Now, at some point that's wrong, and you got to get more defensive. As we look at the current cycle, it's hard to envision that time is now, when we're just at the dawn of a Fed rate hike cycle, and certainly not well within it. So I think you're going to see some volatility forthcoming that you're going to have to invest through, and it's going to spook some people out of the market. And our bet is that that's not the right thing to do here.
Well, will it actually spook some people out of the market? You say this, as a lot of people say, we're overdue for a 10 to 15% correction. We've been overdue for one for probably about a year now, according to Lynn on it.
I think you're in a scenario right now, Lisa, where you just, with inflation running at near 7%, cash is tough. It's a drag, and fixed income yields. I mean, if you're yielding 1.5% or 2% on a 7% inflation, you're setting 5% of your money on fire every year. And I think it's that dynamic that pushes people into equities and makes dips very shallow. So, we'll see if we're sitting here in a year and a half, 2 years from now, or whatever that time frame is, and rates are higher. And the Fed is actively within a rate hike cycle, and you're starting to see the economy roll over, then I think you'll see a different dynamic. But right now, it's really hard to see where else money can go and just not get eroded away by these kinds of inflation numbers.
Steve, is the year over after today?
That's a good question.
I'd love to think so, John, because frankly, I'm looking to take a little bit of time in the last 2 weeks. But the fact that I've got that on the calendar means that we'll have some fireworks in the last couple of weeks.
It's always the way, isn't it?
It's always the way that it works.
You guys have nailed it. I'll tell you.
Steve Cheveron, just fantastic this year, sir, and thank you for everything you've done with us over the last 12 months. Steve Cheveron there at Federated Hermes. Tom, hoping to wrap things up after the close a little bit later.
We're going to wrap it up, and, we're going to try to do some travel in the pandemic. We can talk all show about that. John, we've done some serious work here. I called up Bruno DePure, our wonderful quantitative giant here at Bloomberg, and I said we need an adjustment to the dot plot. Lisa, this is very important. This is the dot plot that matters this afternoon.
I'm so scared.
And what you do is you got to look at the classic Celine polka dot shirt. This is a crepe de chine polka dot print. And this clicks in at $1,300.
How much that is?
So, for a woman that wants to keep up with someone else,
That's not the men's range then, Tom.
I think it is the men's range.
That is the men's range.
Yes, that's the men. Probably someone would own this as well.
People are going to start thinking that that's what I wear on the weekend. Just to clear things up, that is not what I wear on the weekend.
Oh my God, that image is gold.
Do you want to talk about the actual dot plot, Lisa, and what's expected a little bit later?
Sure, if we could move on, honestly. Yeah, we could try to shift, although I will say if you want to talk about inflation, there you go, in terms of how much something would cost. We are expecting some sort of shift. How much can they shift without upsetting the market? What are you groaning about, Tom?
I have to get notified. They don't have my size. They don't make anything that fits me.
What is your size?
They don't make anything that fits me. Trust me.
I'll get you back, sir, big time. Tom Keene.
There's nothing on Madison
Lisa
Avenue
Bramwitz and Jonathan Ferro. Your equity market unchanged on the S&P.
I tried, John.
144.63. I tell you what, this show has a real year-end feel to it, doesn't it? Fed decision coming up a little bit later.
Al from New Jersey is going to say this is the end.
I have no doubt about that. A beautiful one in New York on radio and on TV. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. House has voted to raise the nation's debt ceiling by $2.5 trillion. To extend the government's borrowing authority past next year's congressional elections. It also averts a potential default. The Senate passed the measure earlier, and it now goes to President Biden for his signature. And the Biden administration is considering whether to impose tougher sanctions on China's largest chip maker. That would build on an effort to limit Beijing's access to advanced technology. Meanwhile, the U.S. reportedly will place 8 more Chinese companies on a military-industrial complex blacklist. One of them is drone maker DJI. That's according to the Financial Times. One of the most widely used vaccines in the world, China's Sinovac, doesn't provide enough antibodies to neutralize the Omicron variant. That's according to researchers in Hong Kong. Those findings may have sweeping consequences for millions of people who are relying on the shot to protect them against COVID. And in the UK, inflation has surged to its highest level in more than a decade. Consumer prices rose 5.1% in the last year, driven by high costs for clothing, gasoline, and used cars. The data may be enough to persuade the Bank of England to raise its interest rates on Thursday. Meanwhile, Boris Johnson has survived his biggest rebellion since becoming Prime Minister. Johnson had to rely on opposition votes to pass a key measure to stop the spread of the Omicron variant. Almost 100 members of his Conservative Party opposed his plan to mandate the use of so-called COVID passes at nightclubs and other venues. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Happy holidays from all of us at Bloomberg.
I think the last cycle, you didn't have an inflation problem at all. I think core inflation, this core PCE, was just above 2%. So the Fed wasn't fighting inflation. So in this cycle, you're fighting inflation. So there's even more reason why you should actually have a much higher terminal rate.
That right there was such a fantastic conversation in the previous hour with Alan Ruskin of Deutsche Bank. Look out for it on Bloomberg.com and on the Bloomberg terminal. From New York City this morning, good morning. Tom Keene, Lisa Abramowitz and Jonathan Ferro counting you down to that Fed decision with futures just about positive, up 2 points and advancing 0.04%. Yields are going basically nowhere at 144.80 as we start to think about a consensus view, Tom, going into this afternoon. A quicker taper, accelerate the taper in the dot plot, look for 2 hikes next year, 3 the year after. And a big question for many people, Tom, with all of that already so well discussed,
right,
where does the surprise come from?
Well, where does the surprise come from? And then on to the fiscal policy as well. And those are the domestic fares we can talk about here, John. We're going to do that right now with Julie Norman. She is a lecturer in politics and international relations at the University College London. At UCL, she holds the court on much of international relations, and particularly her focus over years on terror in the Middle East. Julie, I want to start there as we go to the domestic story in a moment. All of a sudden, in the past 3 days, Syria heats up again. Can you explain to me the new Biden projection to the Levant, to Syria and beyond after Afghanistan? I don't understand with any clarity what our new policy is.
Well, Tom, I think a lot of people are waiting to hear what the U.S.'s approach will be to the Middle East, kind of post-Afghanistan, and even just with Biden's overall approach to international relations, which, as we know, is focused much more on China, increasingly Russia. But even in dealing with great power politics, that means you also are dealing with the Middle East. The more that the U.S. retreats from that region, the more it creates a window for China to move in on a lot of economic projects and for Russia to extend their influence as well. What we also see right now is Biden trying to balance a lot of politics in the region around the Iran nuclear situation, which is talks are going on right now, and also with tensions with Israel. Israel, over the last couple of days, reportedly struck back at a couple weapons of mass destruction, chemical weapons sites in Syria, and this is something that is probably going to be something that Israel will be trying to do in the future with both Syria and Iran.
One final question on your expertise here. What is the symbolism of a handshake of Israel and the United Arab Emirates?
Yeah, this was pretty notable last week. So this was a handshake between essentially the acting head of the UAE and then Naftali Bennett. And this was really coming out of a lot of the Abraham Accords, as they were called, that were started under the Trump administration that normalized relations between Israel and a number of the Gulf states. There was already, I would say, de facto coordination happening in terms of trade, economies, that kind of thing. But having this very public show of diplomacy just shows how far at least those relations have gone, even though other relations in the region are obviously very tense. And these ones are not without controversy, of course. But it's for many who watch the region, it's a step towards some kind of stabilizing at least some relations.
Julie, these international discussions bear significance on the domestic one, and I think in particular about a recent push from the Biden team to potentially clamp down on China's largest chip maker, restricting some of the business that U.S. manufacturers do with them. Increasingly, there is a tension here with the inflationary backdrop that we have with trying to clamp down and restrict, whether it's China or whether it's the Iran nuclear deal, and restricting some of their oil exports. How do you sort of view this in terms of the inflation influence?
Well, certainly, Lisa, the inflation influence is going to be cross-cutting, I think, pretty much everything. And we're seeing that in the polls and how much the Biden administration is trying to balance so many of their domestic and foreign policies around that right now. For Iran, I don't think it'll change things that much. That's an area where we've just had such strong sanctions and lack of coordination for so long, it won't really make a difference. But it does impact how we coordinate with Chinese pushback on different kinds of products, and especially chips and technology. This is an area where in the past it's been a pretty easy way for the U.S. to push back in very targeted ways and what they see as certain threats from China. But again, as costs in the U.S. increase, we know that Chinese prices and Chinese trade is one reason why we've been able to keep prices low at other times. So there's going to be quite a balancing act for Biden in terms of managing that.
Based on what you have seen so far, where is the emphasis right now? The sort of geopolitical strategizing or the inflation and keeping it down heading into the 2022 midterms?
I think policy-wise, it has to be on inflation. I mean, for Biden right now, it's not just a question of the 2022 midterms, but really just the impact it's having on citizens. The Wall Street Journal reported this week that over 50% of Americans are feeling the squeeze because of inflation, over 25% in major ways with groceries and gas and whatnot. So Biden isn't going to be content, I think, to just let that sit out there. He's going to keep sending his usual messages in terms of foreign policy with democracy promotion, pushing back against authoritarianism, and stepping up when need be against, say, Russia or potential threats. But at the end of the day, he's got to be focused domestically.
Julie, you're one of the best, and it's always good to hear from you. Julie Norman there of UCL on the latest geopolitical situation. Throw in Europe too, Tom. Chancellor Scholz this morning making a statement on how Europe needs to be united in seeking dialogue with Russia. Going on to say a new version of this policy must be a European Union initiative rather than one directed from Berlin.
And part of this at year end is just time marches on. I mean, Merkel over to Scholz, and we launch into 2022 into 2024, other elections. Look at the French government and the turmoil there of an election. All of a sudden, Mr. Macron threatened. It's eventful, to say the least.
A long winter, Lisa, coming up.
It just highlights how difficult it is to put pressure on a place like Russia when they're supplying your gas. when they're supplying the basic inputs for your daily existence. And if you cut them off to try to punish them, you end up, shooting yourself in the foot. And this has been the big concern. How much can Germany push back against Russia, given what we're seeing with natural gas prices surging to record highs, and their sort of geopolitical significance? And you're seeing this also for the U.S. and China. How much does the U.S. crack down on China if the goods they import from China help keep inflation low? I find this fascinating.
I agree. The team at Bloomberg writing up the following story, Tom. The Chancellor reiterating that any violation of Ukraine's borders will carry a heavy price for the Kremlin. What would that price be, Tom?
It's got to be sanctions. I'm by no means expert here, but sanctions, they do work going way, way back, and there can be levels of sanctions. That's the area of Dan Tannenbaum and others.
Yeah, and forgive me for saying a long winter coming up. It's far too depressing for this time of the morning. Futures are just about negative. They're down a point on the S&P 500.
You're emotional, John. You've lost your focus.
I've just been around Lisa too much, Tom. You left me alone for 2 days.
We merged yesterday, evidently,
well,
on
did,
Twitter.
It was absolutely terrifying.
Horrifying. Absolutely
144.63 on 10s has been the surprise for many people of the year so far. Yeah. How on earth do we have 6.8% inflation, nominal growth on fire, and a yield sub 150 on 10s?
Our Twitter feed is an embarrassment.
Do you want to give me a flavor as to why, Tom, before I check?
We got somebody just put out Celine Dion and black dots. I think it's a Celine dress from like 2004.
You could rock that. I don't think I could pull that one off, Tom. Just that little shoulder piece. Nice. Yeah, from New York on radio and on TV. This is Bloomberg.
Oh, this looks great on radio.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
It is Fed Decision Day, live from New York City on TV and radio. This is Bloomberg Surveillance, and here's the price action. Positive about 0.04% on the S&P. On the Nasdaq right now, down about 0.1% on the Russell. On the small caps, up 2, positive 0.1%. Coming into today, Tuesday, Monday, losses. 2 days of them coming into Wednesday ahead of that Fed decision. That's the equity market picture this morning. The story I want to talk about in the bond market, 2s, 10s, and 30s. And as we wrap up the year, or at least I'm wrapping up the year and other people are too, Lisa maybe not, I want to talk about where the 10-year has been and where it's ended the year. And likewise on 2s, because there's a story in there. The high of the year on a 10-year yield this year, 177, the end of Q1. The end of Q1, there was this belief that the Fed would tolerate higher inflation, that we'd allow that growth, that inflation story to build, and we'd get a steeper curve. The highs of the year on 2s, a week ago. That's the story, isn't it? That we've got the high of the year on 2s at the end of the year, and the high of the year on 10s 9 months ago. So we've got a flatter curve, we've got a different story, a Federal Reserve, Tom, that many people believe is less tolerant now to the inflation story, a belief they've got to adapt.
Well, they've got to adapt. One of the outlier calls here is curve inversion, where the 2-year yield goes up, John, 10-year yield does what it does, and at some point we get a odd inversion. I mean, I think there's a lot of uncertainty within the quiet of the bond market.
Well, this is to go back to the conversation we had with Alan Ruskin at Deutsche Bank, Tom. How much work does the Fed need to do at the front end? How much will the dot plot later capture that story? And will the Federal Reserve Chair himself talk about that in the news conference later?
John, I think we got to continue the data check. I would really want to know, John, LVMH over in France has had a phenomenal year as well. Since they've owned Celine since 1996, I think that, you know, it's important to quote.
You can do a stock check a little bit later. Oh, there we are. At 1.4% on the day. I have no doubt that's down to your free promotion for most of this morning, Tom. I'm going to finish on foreign exchange, switch on the board and get to the US dollar. Your dollar index on the year, over the last year, so the last 12 months, not year to date, we've had a move of 6-7 percentage points.
It's a big move.
Tom, it's
weak
been
dollar,
a big
it's going to
move.
happen.
Expecting that weakness, we got that strength. And maybe the surprise of the year, Tom, is not that. It's the fact that even with that, the Chinese currency has been stronger against the US dollar year to date so far.
Yeah, waiting for 15 as well on Lira. We're not there as well.
We're not there just yet. We're not there yet. Are you done with your luxury coverage?
Oh, no,
Here's
we're
the
never
truth of
done.
it. If Tom was an analyst, a single name analyst, Lisa, falling under his coverage would be the luxury names.
He's actually trying out.
I'm not sure how many people actually know this, but that is the case.
100%, but it would also be the Bloomberg Shopping Channel, which I think we're dramatically going toward.
We're drifting towards that. There's a Fed decision today. Can we wrap it up, Tom? Your dollar index, 96.47.
John, let's wrap it up.
We're going to do that right now. That was your cross-asset price action. Let's get you some single names and say good morning to Romain. Morning, Romain.
Hey, good morning. I feel like I missed some conversation here. All right, take a look.
Stay out of it. You don't want to be involved, Romain.
All right, we'll take a look at this beautiful board behind me. This really kind of sums up what we're seeing here in the pre-market. Basically, stasis for our radio audience. Basically, everything is either up or down fractionally or unchanged here on the day. The big event, of course, in about 6.5 hours where we get the Fed decision. That's going to drive a lot of this.
Yeah,
we saw,
Romain, I got it. You've nailed this. Netflix, Adobe, and Microsoft.
Yeah.
What are your take on the lack of breadth right now?
Well, my take is really what we're hearing out of the analysts here, which is this is really a valuation story right now. And the idea here that as you have a less accommodative Fed, combine that with, of course, all the inflationary pressures that are leading to a less accommodative Fed, the question is, do these valuations hold up? Most of the analysts we talk to say no. That's why you get a price target downgrade today on Netflix. That's why you saw Adobe sell off 7% yesterday. Microsoft down 4% over the last couple of days. And pretty much everything in the tech space now has been relatively weak, or at least relative to what we saw saw here in the middle of the year. And I think a lot of people are saying, Tom, that this is going to persist, particularly if we get the expectation that there's some sort of acceleration or signal of an acceleration of pulling back some of that accommodation.
Yeah, we'll have to see.
All right, well, you flip up the board. You want some beneficiaries, Tom. There's no LVMH on the board, but some of the bank stocks could potentially benefit. And there's actually some interesting commentary about some of the material stocks. Analysts sort of mixed on this. Some are saying that they could actually benefit here from this new environment, while others are saying maybe not. Albemarle actually getting downgraded today, primarily because of that, Tom.
Romaine, thank you so much. Greatly appreciate it. To close here, an important close, and of course, Mr. Bostic joining us on our Fed coverage this afternoon on the equity market reaction to the emphasis taken in the press conference. Dana Peterson now, chief economist at the Conference Board, and what's important is our other guests focus on the unique skills of the Conference Board of measuring American economic dynamics. Dana, good morning. This is such an important conversation on the ability to sustain economic growth. What is the call that you have 12 months forward on real GDP?
We're thinking that we're probably going to expand by around 3.5% next year. And that's not including a Build Back Better plan. Certainly, if the Build Back Better plan is passed, then we could potentially see growth around 4%.
So you're talking about China-like nominal GDP. We're going to have, who knows the number, 6, 7, 8, 9% top-line GDP. What does that do to the Conference Board's corporate America?
Well, certainly that would be positive if a lot of that's driven by consumption. And certainly we're anticipating that hopefully next year that much of the services activity will return to pre-pandemic levels, or at least approach that level. And that's really going to be highly dependent upon the evolution of the pandemic, whether or not people are vaccinated, whether or not people feel comfortable getting out there and going on trips, traveling, visiting restaurants, hotels, et cetera.
Dana, in about an hour, we're going to get those U.S. retail sales for the month of November. We expect an increase. How do you parse out the increase due to inflation from the increase due to consumers with an ever strong pile of cash willing to spend?
Sure. I think the easiest thing is just kind of take that nominal headline and deflate it by the CPI, and you'll see essentially that much of it's probably going to be related to price increases. But still in all, our own survey suggests that consumers, even though they're a little bit dour on the outlook, they're still willing to spend. Certainly our holiday shopping survey said that people were willing to get out there and spend, especially go to malls and do in-person shopping. So we're anticipating that that's going to show up in the retail sales today.
Does it matter that they're shopping at LVMH, perhaps, and some of the other luxury providers? I'm not going to go back into that. And that perhaps they're restricting some of their purchases at Target, at Walmart, where you're not seeing as easy of a pass-through in some of the inflation?
Well, I think it really depends upon the shopper. The person who's shopping at, Walmart or Target may not necessarily be shopping at Louis Vuitton, but certainly consumers do have pent-up savings that they've had, certainly because we had big stimulus checks. Also, many more people are employed relative to when they were before. But certainly, we're going to see more caution in terms of people looking for discounts. And certainly, if that's not delivered at the big box stores, then we're going to see weaker spending going forward.
As a general statement, what is the strength of the consumer? I have trouble with a weak consumer in a 9% nominal GDP economy.
Well, the thing is that the consumer really isn't weak. It's just that they have soured in their opinion, given the fact that inflation is high. They're still worried about COVID. Cases are rising. We have Omicron in front of us potentially. But when we look at incomes, they're still very high. Many people are working. Our unemployment rate is at 4.2%. That does not signal a weak consumer. It just says that maybe they're just a little bit soured right now in the environment.
So how do you square what they say and what they do? And we're talking about the University of Michigan Consumer Sentiment Survey that's actually been deteriorating, a slight rebound last month, but not much. At the same time that everyone comes on and says the consumer is incredibly strong and willing to spend.
Well, consumers may say one thing, but what they do is more important, and what they do we can find out in the retail sales and the PCE data that we receive later on in the month. And so far, consumers have been getting out there and they've been spending.
Dana, we've got to leave it there. Thank you. Dana Peterson of the Conference Board. Sorry to cut you short there, Dana. Just getting some news, Tom, from Secretary Blinken's member of the travel pool, the press pool, Tom. testing positive for COVID, and they've had to cut that trip short. We learned this morning through our routine PCR testing that a member of our travelling press pool tested positive for COVID-19 upon arrival in Kuala Lumpur. Just an indication, Tom, of how difficult it is right now to get things done, to move around the world.
Anis Shuki and Derek Wallbank off the Singapore desk reporting on this. And John, it really goes to the dynamics that the surveillance team faces in travel, and certainly the Secretary of State, and I'm going to assume 100 people moving him around face, is testing every day, whether, John, help me here, it's a 3-day PCR test and then the rapid antigen. Can you see the Secretary of State on his phone in the terminal on Air Force 2 or 3 or whatever he flies, doing the Navica, Abbott Labs test?
Hey, Tom, travel is getting really difficult, away from the jokes. There's a belief that these governments are going to do even more to make it even harder to travel around the world now.
I was trying
and if
to
you
be
speak to the medical professionals, Tom, what they'll tell you is that for the most part, it doesn't make a massive difference. It's an easy way for a politician to look like they're doing something, and it seems to be the lever they reach for on any given day.
Well, and John, it's just level 4, level 3 in England, France, and the rest of the Europe. I mean, they're moving it around, and I agree it gives politicians cover, but the answer is the variant's spreading. And the answer is deaths seem to be somewhat contained and hospitalizations are problematic.
And yet when, Tom, we asked this question, Lisa, we've done it the last couple of days, can we draw some conclusions just yet? And we'll be told, no, you've got to wait for longer.
No, it's true. And honestly, Tom, this is, to me, you talk about messaging and politicians trying to go out there and giving a sense that they're doing something about it. I do wonder, how much people will actually get that message versus really, again, we're going to go back to that.
Is West Ham Arsenal like 30,000 people today, or is it like pandemic, like quarantine?
No, I think it's going to be a lot, Tom. It's going to be a lot at the Emirates in the Arsenal Stadium. I heard back from Kit Dukes of SocGen as to whether he'll be watching the game, Tom, or if he'll be on the Bloomberg terminal when the Fed decision comes in. And Kit said, I wish that the Emirates had a Bloomberg terminal, because I think Kit's going to be at the Emirates,
I think
Tom,
that sounds like a sales potential for Bloomberg.
But perhaps to Arsenal Football Club.
You and I and Lisa could go over and do a remote with West Ham Arsenal. And
if you're just tuning in, a member of the press traveling alongside U.S. Secretary of State Antony Blinken on his tour of Southeast Asia has tested positive for COVID-19. This according to the State Department Post spokesperson. From New York City, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. The U.S. death toll from the coronavirus pandemic has now passed 800,000. That's according to data compiled by Johns Hopkins University. More than 200,000 of those deaths occurred after vaccines became widely available last spring. The U.S. has the highest reported death toll of any country. The House has voted to hold former President Trump's last chief of staff in contempt of Congress. Mark Meadows has refused to testify in the Capitol insurrection investigation. He's turned over emails and other records, but Meadows cited executive privilege in refusing to appear before lawmakers. Congress is seeking to increase pressure on China for its treatment of Muslim Uyghurs. The House has passed a bill that would ban goods from the country's Xinjiang region unless companies can prove they were not made with Uyghur forced labor. China has denied those allegations. And a new report says car makers like Volkswagen and General Motors should brace for the global chip shortage to last beyond next year. Munich-based consultancy Roland Berger says they need to redesign cars, so they need fewer of the high-tech components. The shortage has prompted vehicle production to plummet. And Bloomberg's learned that French billionaire Patrick Drahi is considering a U.S. IPO of Sotheby's. Drahi bought the famed auction house a little more than 2 years ago for $3.7 billion. Sotheby's has had strong online sales during the pandemic and has been moving into digital offerings as well. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
From the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
That China as a long-term, as long-term as an economy, as a fundamental story, we believe generally remains intact. It's just gone through a pretty aggressive rebalance this year, and I think as you go into 2022, we think there is a pretty large opportunity for the multiple and for sentiment to improve.
It has been too long. Fantastic to hear from Dubravko Lekos-Bujas, the JP Morgan Global Head of Equity Macro Research. They've got a constructive outlook for 2022. From New York, alongside Lisa Bravitz and Tom Keene, I'm Jonathan Ferro on this Fed decision day with equities up 3, advancing 0.06% and yields up 1 on 10s to 145.48. That Fed decision, Tom, 2 p.m. Eastern Time.
It's a big decision. This is not a normal meeting. For those of you on radio and TV, stay with us through the day as well as we drive towards a meeting. As John mentioned off Steve Englander at Standard Chartered, the emphasis taken in the press conference. Our Michael McKee, of course, leading our coverage. Right now, leading us with a chart here on retail. Kriti Gupta joins us this morning on her take on it. What do you have?
Yeah, well, talking about retail sales, we just heard from Dana Peterson ahead of the retail data we get at 8:30 this morning. I want to put that into some perspective, though, because we know that sales are booming across the board. Compare that, though, to a 5-year chart where you start to look at the trend line, and it's actually booming in a really big way. The question is the momentum waning? Because, as Dana mentioned, stimulus, the effect of stimulus is coming down. To
describe this on radio, Kriti, we got a trend, we got a pandemic, we got a recovery, and then a pop. Is that all a fiscal pop? Do you say fiscal policy, retail big?
This has everything to do with the savings rate. And for our radio audience, essentially you have this major dip in 2020 when everyone was kind of holding on to their funds, putting their cash under their mattress, and then this major pop ahead ahead of this huge trend line. The question here, once again, comes down to the savings rate, which is recovering from the highest in history, even higher, Tom, than the Great Depression era, and now it's kind of coming back down to earth. So the question is, do we continue to see this boom in retail sales?
Kriti, thank you so much. And we drive there to her outlook released this morning, 2022. Poonam Goyal joins us with Abby Gilmartin, really diving into the state of retail. Poonam, can there be a repeat to retail in 22 like we saw? Wait, Poonam, your backdrop. I mean, which Bloomberg office are you in?
Not sure. I think it's not in the market.
John, we got to take notes here. I mean, you and I need a green screen. I mean,
I've been dreaming about having a green screen as the backboard on the bed, Tom.
Yeah, you know, it's
the
great.
Headboard. I think it'd be just wonderful. You set a camera up at the end of the bed, you wake up and just do the show.
Do the show. It's
Maybe
great.
that's what we're doing right now.
Nice. We're learning, Poonam, we're learning from you every day. Teach us about 2022 retail. What will be the distinction?
I think there will be two parts to 2022. The first half, we think we will continue to see the boom that we saw in the latter part of this year. However, as we move into the second half, I think retail sales could slow again because people will not be shopping in stores as you saw them this year. We think the real shift will be towards online, and it'll be more material next year. So all in all, if you start to see rates rise, which we think will be a key indicator for consumer spending next year, we think spending could derail a little in the back half.
The common idea right now is that consumers have looked through the inflationary push and continue to buy more and spend more in case there is any concern about a waning consumer appetite. Are there any signs under the cover that that's starting to shift?
Right now, no. Through the holidays, we've actually seen robust demand. And the one thing I'd point to is promotions, right? Typically in holiday, you're looking for a lot of promotions, great deals, larger discounts. This year, we didn't see that in stores. There were discounts, but they weren't as high as they've been in. And consumers are still purchasing. And the trend from November, as far as we've seen, has continued into December.
Is there a bifurcation, Poonam, in the level of the items in terms of how expensive they are for luxury goods stores doing well and the Walmarts and Targets of the world having a harder time passing along inflation, or is it very broad-based?
Right now, it's very broad-based. I mean, we saw it in the numbers at Walmart and Target recently. Top line has been off the charts across the board for retail. The concern really is margin. That's what we're all concerned about for 4Q and moving into the first half of next year.
Poonam, you've got an outrageous call that in 3 years, we will have 50% of apparel will be online. How does luxury do that? How does, for example, Celine drive everyone to online?
So it's not luxury, it's more apparel. So if you think about the Macy's, the Nordstroms, the American Eagles, the Lululemons, those are the retailers that we think will make a bigger push towards online. And some of them are already there. Nordstrom's at over 40% of their business is online. So they're already making headway. We heard from Nike, 50% of their sales come from online over the next few years or so.
How does Amazon, not so much defend against that, but how does Amazon do apparel if they haven't done it before?
They're already doing it. Amazon Fashion, we don't know the numbers, but we know that it's doing really well and they're gaining momentum. Amazon across the board, you know, it's about convenience. It's not about price. It's about the third-party providers bringing new inventory onto the platform every day. And that's what's attracting users. They can get it instantly. To me, Amazon is my Google, where that is where I go to search. And if I find it, I click, I get it next year in 2 days.
That's smart. Poonam, always good to catch up and love the background. Poonam Gaur there at Bloomberg Intelligence. Poonam, thank you. Tom, for a long time, US retail sales, US retail has been well behind. Over the last couple of years, they've really caught up. This big omnichannel, so-called omnichannel push, Tom, let me give an example with Nike. Black Friday sales, brought something, got delivered a couple of days later, didn't like it, walked up the road, went to the store, took it back. That's the kind of thing you want, Tom. Click and collect, go around the corner, pick it up. Order it on your phone. You want that ease. Just get rid of all the friction. And most of these big players, Tom, have made a massive effort to do that over the last couple of years.
Is Romaine mentioned Adobe, Microsoft, and Netflix before. Do we know, John, or do we underestimate the technological advance that's happened with this pandemic? I think all of us are learning as we go. I don't think we really understand.
My experience, Tom, and I'm conditioned by experience, of course, and Lisa, is that we always underestimate these tech players and continue to do so.
and just how much they've gotten woven into the fabric of every experience. And it's not just technology in terms of ordering it online. It's tracking different customers, understanding their profile, understanding how to cater to them, understanding when they're fraudulent, understanding all of these different things that data now gives retailers the tools for, and the ones that adapt to them the quickest are the ones that are going to be the most successful. And that is the shift, I think, under the headline of just a move to a technology.
Went to Bloomingdale's, bought a suit. Then all of a sudden they know my size, my shirt size, Lisa. They start pushing the shirt sizes to me. That shirt in that size, in the color they think I'll like, to my inbox on sale.
Yeah.
Let's go.
You've been tracked, and does that bother you?
It doesn't bother me if it's convenient.
Exactly. And I think that that's what people are finding.
I tell you when it bothers me.
When
it follows me around to another website. That's when it bothers me. When you're trying to resist the urge to buy something and it follows you somewhere else.
Like what?
So let you go to...
Like what type of thing?
Let's say an item of clothing, maybe some sneakers, whatever it might be.
Yeah.
And then you go to the sports page of the Daily Mail website to get up to speed on the Premier League stuff. And then all of a sudden that item of clothing is down the side, just following you.
Yeah, I mean, it can
here.
follow you, and on a Fed day, it particularly follows you as you consider the dots moving forward. And John, it's going to follow you and Lisa and me all through the day, looking at the Celine dots, chemise.
Tom, look, we've got to do this. Bottom line, here it is. I don't have one of those, but I know someone who does. Tom Keane has a shirt just like that one.
Ooh.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, Bloomberg surveillance. The Fed decides. What's the Fed's forecast? Will they speed up tapering? Will we see earlier rate hikes? Tune in Wednesday starting at 1:30 Eastern on Bloomberg.
It's really a reminder
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
Central Bank 101 is you kind of want to look through some of the, if you like, supply-driven increase in inflation.
The risk of a 60s or 70s style inflation story is overblown.
I'm expecting the Fed to not make a policy mistake. They're going to err on the side of easing.
This is an economy that just simply does not need additional accommodation.
The Fed is well behind the curve.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The sum of all your fears on this Fed day. Kenneth Rogoff in this hour, and in moments, David Kostin of Goldman Sachs. John Farrow, David Kostin, and others have been right. It's a bull market.
They've been bullish, Tom, and sometimes this year, if there's one criticism, it's you haven't been bullish enough. This equity market is delivered in a massive way this year. Looking ahead to next year, Tom, it's all about multiples, and to what degree does the Federal Reserve bring those multiples down with a move? Today, what are we expecting? An acceleration of the taper. We're expecting to see a couple of hikes in the dot plot for next year and 3 more in the dot plot for the year after that.
John,
where will the surprise come from if we get one?
Well, the surprise may be, as Steve Englander says, the emphasis within the press conference. How do we link, John, what Jerome Powell will say to the somewhat fragility of this great bull market?
To what extent has his base case shifted? I think Steve Englander is so right to think about the emphasis of a central banker. That's where they have the power in the news conference. How data dependent is that first rate hike, Tom? Is it just a straight line from here, accelerating the taper, wrap it up the end of March and let's go? Or is it a case of looking at the inflation data through Q1, assess the degree of deceleration you expect to see in inflation, and then work it out from there? I wonder where he'll push a little bit later in that news conference.
Lisa Abramowitz, our bond team, prints in Bloomberg News today 2 killer stories on the bond market, and one of them is about the primal scream needed for the bond market to get the Fed's attention. This is a quiet bond market.
Basically, it's going along with what the Fed said 6 months ago, which is transitory. It's saying that we're going to see near-term inflation peak, and then it's going to come way down. And in the meantime, we cannot get neutral rates up to a significant place, or frankly, any place that they have been historically, because of how much debt there is, because of demographics, and because we are going to go back into a more secular stagnation type of paradigm than what we've seen over the past 2 years.
What's the fixed income metric, Lisa, where in Lu Wang's story, markets will need to scream? What's the thing in bonds that will make Jerome Powell scream?
Inverted yield curve, that will make him scream. Also, if you start to see some real volatility in terms of how much things are swinging around and this feeling that people are really unmoored, or potentially a big surge in the back end of the yield curve. But honestly, I don't see it right now because they have had such an influence in distorting this market.
As we get to the data check, John Farrow, a tinge of emotion as we face this December 15th, our final show together this year. All 3 of us, with our separate lives and our separate travels, always cherish the final 8:03 data check of our year.
I cherish you, Tom. I really do.
You're so sensitive.
Equity futures unchanged on the S&P.
Do the Dow.
Yields
Down,
unchanged
negative 25.
144.80. Just for you, Tom. Where are we? Down 25. Negative a tenth of 1%. 30. Look at that. 35K. I've got the hat ready. Tom, this from Jonathan Golub, Credit Suisse, just publishing. While Jay Powell has backed away from the term transitory, there is little indication that he believes inflation is sufficiently entrenched to justify inverting the curve and stifling demand. Put differently, we believe the Fed will avoid such restrictive policy, providing continued support for economic growth and risk assets. Jonathan Golub, Tom, just moments ago.
Very good. And of course, everybody recalibrating here as well. Let us start strong. Kenneth Rogoff coming up in this hour. with David Kostin, Chief U.S. Strategist at Goldman Sachs. He's been a huge advantage to us in describing a bull market that he needs to be invested in. The big fear right now, David, is this silliness over breadth, 5 stocks going up, everything else terrible, and the fear of a drawdown. Tie the two together.
Well, the subject of a drawdown, of course, will bring happiness to Lisa to hear about that. But the idea of a narrowing breadth market is, I think, an important characteristic of the last 6 months. So there's been a relatively few stocks that have driven the market to these pretty much record levels. And the history would suggest that over the next 3 to 6 months, you'll get a larger than average, a deeper than average drawdown. Say, for example, instead of a 4% drawdown over time, over a couple month period, you may likely get an 8% drawdown. That's what history would suggest once there's such a significant narrowing of breadth in the market. However, if you think about where you end the, not just the year, but over that period of time, equity prices likely to be higher. Why is that the case? All of the focus today and your conversations before have been about the announcement of the Fed today and the dot plot and the tapering. All those are important. But the fundamental issue in equities has been this year, you've had a huge spike in commodities. You've had supply chain disruption. You've had difficulty in companies finding and keeping employees. And you've had the variants, the Delta and the Omicron, all these issues, yet profit margins in the United States across every sector are at record high levels. Managements have been very nimble in basically dealing with these issues. And so we look into 2022, earnings up around 8%. Largely, the economy is still growing at a decelerating pace, margins increasing slightly. That is the story for 2022. You have a flat valuation, in my opinion. That's how you get to 5,100, or up roughly 10%, maybe 11% total return when you add in dividend yield.
So, David, just to be clear, I'm not rooting for a downdraft here, but I do think a lot of people have been talking about how things look perilously valued. Your argument is they are not, because you're going to get the ongoing margin, a sort of incremental growth in terms of how much they're expanding. What's the down case scenario, just because I want to be in brand here? What's the sense that we're going to get some kind of rate hike or savings accounts that get depleted and the consumers say, no mas, we're not going to accept and give you money and not only pay you enough for more inflation, but then more?
So, Lisa, the disconnect and the discussion with most portfolio managers relates to the situation that fast growing companies that are fast profit profit growth, and high margin companies trade at basically the same valuation as fast growing, but negative margins, losing money, or very thin profit margins. Those two groups of stocks is anomalous that they would be trading at roughly the same valuation. To give you a number, roughly sort of 9 times enterprise value to sales. What are we talking about? We're talking about companies with a forecast of, say, 20% revenue growth, both sides, but some are having 20% margins, others basically companies losing money. And the issue is, as rates go higher, and to be clear, that is the forecast of Goldman Sachs, that 10-year Treasury yields will climb towards around 2% at the end of next year. In that environment, it is exceedingly unlikely that you get the same valuation for these two groups of stocks. And the idea the market is unforgiving if companies which have high revenue growth and all the valuation is dependent on that revenue growth, as compared with companies where there's rapid revenue growth, but there's also high profit margins to work with. That's the central tension in most conversations with fund managers, because so many of the money-losing, loss-making growth stocks are very much in the meme specter, or the sort of glamour stocks in the market that everyone has been so benefited from in the profit over the last couple of years in terms of performance.
David, the obsession now, as you know, is to look forward 12 months. Can we just reflect on the last 12 months briefly? I remember about 12 months ago looking at your original forecast for the S&P 500, which was 4,300. And when that first came out, I think the S&P was in and around 3,500. And we looked at your forecast, looked at JP Morgan's, which was a little bit higher, and everybody sat there and said, come on, this is ridiculous. We're really going to have a year that big. We broke through 4,700 before we got to the end of the year. David, I want to understand from your standpoint, when we play this game each and every year at this time of year, when you look back 12 months, what's been the biggest lesson for you and the team as you speak to clients?
So the biggest lesson, and you were right, at this time last year, our forecast for the S&P 500 at the end of 2021 was 4,300, and we lifted that to 4,700 in August. The biggest surprise has been the resilience, in my opinion, the biggest surprise has been the resilience of corporate margins. And that's been a key driver of why you've had earnings, and it's really been an earnings-led market. I think that's really the most important development. It has not been a valuation expansion story. It's been a earnings-led market. And I look into 2022, Jonathan, and that is the same outlook that we're anticipating, which is earnings climbing around 8%. The other aspect that was surprising to me is all year long, and when you've invited me on as a guest, most of this year, we've been looking and handicapping the probability of a higher corporate tax rate. We were assuming most of this year there would be some legislation passed, some reconciliation legislation passed this year and affecting and headwind to profit growth next year. But now it looks as though whatever legislation may or may not be passed, and I do expect some legislation to be passed, but that tax headwind, tax hike, will not affect company profits until 2023. So basically that extra earnings inures to the investor. That's the other. So profit margins and the lack of an increase in tax legislation, I think, have been the two surprises to me.
David, your distinction is you say just shut up and own them, own a high growth, own a high margin, own a high profit stocks. And there's X number of those as well. Are they under-owned or over-owned right now?
Well, it depends if you want to talk about the hedge fund community or the mutual fund community. So, Tom, that makes a difference.
Please make that distinction.
Which clients we're looking at. So if you look at the hedge fund community, the levered community, basically owning the leading stocks in the market, that's been persistent for 20 years. We look at this every 90 days and been looking at this since 2001. And that's been pretty much in the last 4 or 5 years, the same stocks, the leading stocks in the market, largest companies in the market, have been dominating their performance and their portfolios. And that's pretty much in similar to the whole index, if you will. If you look, and so they're overweight, those stocks. And then you look into the mutual fund area, and they're significantly underweight. And here we're looking at large cap core managers, value managers, looking at a different benchmark and growth managers. But in terms of your core mutual fund managers, they're actually underweight those larger stocks, in part because they're such a significant weighting in the market. 5 stocks, 25% of the market.
John, this is incredibly important, this insight from Mr. Costin, and it compares and contrasts to what we saw with the Nifty 50 a zillion years ago.
Just getting some news, Tom, I want to break, and then we'll return back to David Costin. The Prime Minister Boris Johnson holding a news conference from Downing Street at 5 p.m. local time, so midday Eastern time, Tom, to talk about Omicron. The reporting out of the UK right now, not expecting to get new measures, expecting an update on the booster program. So one for the diary a little bit later. David, I want to come back to you on multiples. We talked a lot about earnings. It's been the big surprise of this year. You're talking about earnings being the big surprise for next year too, potentially. Let's just sit on multiples for a moment. There's been some confusion around why multiples are so elevated. I want to understand what it is from your perspective. Is it that early recovery where earnings start to deliver upside surprise, beat and raise, beat and raise? That's where Deutsche Bank sit on the idea. Or is it the fact that rates are low? And if it's rates, what does that mean for the Fed and what that means for multiples going forward? Can you give me your view on that right now, David?
So we think about valuation on an absolute metric. If you look at enterprise value to sales, enterprise value to EBITDA, price earnings multiple, any of those metrics, the equity valuations are extremely high. I would say the rationale for the market being reasonably attractive does depend on the extremely low interest rate environment that we have, whether that's corporate bond yields, tips, inflation, protected securities, or even nominal treasury yields. In all those interest rate related metrics, equities look reasonably attractive. So, Jonathan, an important construct to think about is that in history, it shows 6 months before a Fed hike, 6 months after a Fed hike. That 1 year period, basically you have multiples flat. In every one of the tightening regimes that you've seen over time, that's been the experience. And so that happens to match up pretty closely with calendar year 22, coincidentally. You're starting now, it's about 6 months before the expected first hike, and 6 months after would, of course, put you at the end of 2022. That's not the forecast for a stable multiple. That's not upon which we make the forecast, but as a result that's consistent with history. The way we think about it is rates are going higher, risk premium going a bit lower. Why is it a bit lower? Consumer confidence remains high, unemployment falling, and wages are increasing, number one. And number two, the policy uncertainty I referenced earlier about tax hikes, the election for next November. So once that's beyond us, you'll be basically back to a roughly stable valuation, around 20 to 21 times, which is the valuation now, historically high, but still reasonably attractive in a low interest rate environment, even with rates rising.
David, just brilliant. I hate to reduce the whole body of work to just an index level call, but fantastic on the index level through much of the last 12 months, sir, to you and the team. Good to catch up, as always. Enjoy the holidays, David. Thank you, sir. David Costin there of Goldman Sachs. Tom, they were looking for 4,300 originally 12 months ago. That got upgraded to 4,700 in August, and we are just short of that after breaching it over the last couple of months. 4,634 at the close yesterday.
What permeates their decks is that corporate America will adapt. That is the number one thing I see off of all the legacy of Abby Joseph Cohen.
This constructive view on earnings, that's what's really delivered through 2021. Will it do the same in 22? From New York City on this Fed decision day with Tom Keene, Lisa Abramovitz and Jonathan Ferro, your equity market unchanged, your 10-year 144.80. From New York, heard on radio, seen on TV, this is Bloomberg Surveillance.
With the First Word News, I'm Rishika Gupta. President Biden will get a first-hand look today at the devastation caused by tornadoes in Kentucky. He'll meet with storm victims and local officials there to offer federal support. More than 30 tornadoes ripped through Kentucky and 4 other states. At least 88 people were killed. The Biden administration is considering whether to impose tougher sanctions on China's largest chip maker. That would build on an effort to limit the country's access to advanced technology. Meanwhile, the U.S. reportedly will place 8 more Chinese companies on a military-industrial complex blacklist. One of them is drone maker DJI. That's according to the Financial Times. U.S. Secretary of State Antony Blinken is cutting short his trip to Asia. A reporter traveling on his tour tested positive for the coronavirus in Malaysia. The reporter has been placed in isolation. Blinken will skip planned visits to Thailand and Hawaii. One of the most widely used vaccines in the world, China's Sinovac, doesn't provide enough antibodies to neutralize the Omicron variant. That's according to researchers in Hong Kong. Those findings may have sweeping consequences for millions of people who are relying on the shot to protect them against COVID. And in the UK, inflation has surged to its highest level in more than a decade. Consumer prices rose 5.1% in the last year, driven by higher costs for clothing, gasoline, and used cars. The data may be enough to persuade the BOE to raise interest rates this Thursday. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
This is the Bernanke legacy of Federal Reserve. We think they're going to be very careful. But the irony, though, of all of this is the market is freaking out because the Fed is getting really considering, tapering at a more aggressive pace. The market has been dying for the Fed to taper.
There's always something to complain about, John. You know that. John Stolford's there, Oppenheimer chief investment strategist, the most bullish on the street. Year-end on the S&P into next year, looking for 30 points higher than Brian Bowski of BMO. And the equity market up a point this morning, Tom, on the S&P. Futures going nowhere. Yields going nowhere too. 144.45 on 10s.
We're going to pause here. John, the hallmark of what we do is to have respect for those that get it right, those that get it wrong. But I just want to emphasize in the Wall Street crush, John, it is so hard to do what Stolfus, Costin, Dwyer, Gino Martin Adams have done, which is to participate in the market through thick and thin. They've been just lights out.
They've been absolutely fantastic. And Tom, I said to David Costin, let's not reduce the body of work to just an index level call. There's so much going beyond that. going on beyond that, beneath the index. So let's pick a house that struggled with the index, say Morgan Stanley.
Right.
Struggled at the index level, but made some great calls beneath the surface on small caps, the churn beneath, and some single names calls as well, Tom.
And one thing's so important, folks, is you read the people opposite of your call on the street. So if I'm bullish, I'm reading Morgan Stanley's Mike Wilson to learn from that as well. On China, we read Enda Curran, and he joins us now in the tumult of year-end China. And I don't know where to begin in a 2-hour discussion. What is the single thing Mr. Xi is worried about domestically?
I'd say it's the effectiveness of China's vaccines, Tom. There was a report out of the Hong Kong University saying that basically their effectiveness against the Omicron variant is pretty low. If that's the case, that will certainly pressure China's zero COVID strategy, because given the transmissibility of its new variant, it would surely suggest more disruption. Remember last year we had disruption at some of the key ports. Consumer consumption is still weak because of the ongoing disruption. When there's an outbreak, they come down hard on it. So I think the variant and how it holds up against vaccines is probably going to be the biggest concern for him, as well as managing what's happening on the property side. We got more data today pointing at a slowdown in the property sector. So two things going on there, Tom. It's still the virus, and it's the debt and leverage story in the property side of China's economy.
And we focus on China as it is the world's second biggest economy, but it also is essential for supply chains and some of the disruptions that we've seen. And it is a huge generator of economic wealth, at least over the past couple of decades. How concerned is the People's Bank of China, is the Politburo, over the retail sales number that came in way below expectations, with this idea that people are not going out and spending, even though they have perhaps the cash, but there just isn't the confidence being expressed in some of this economic data?
And neither is the virus running wild in China. It's a very interesting case. In fact, when you look through the numbers today, Lisa, restaurants and catering were hit hard, and there's also weak. The car side of things was quite weak. Automobiles was quite weak, but that might reflect the shortages of chip story. But nonetheless, though, this nervous consumer story is a key concern for them. The authorities really haven't been able to get spending revved up. It was thought that the November numbers might be better because it's a big month for the online shopping, the Singles Day bonanza, but that didn't really come through in the bottom line today. And I think now, as I said earlier, when we're talking about this Omicron variant and whether or not the vaccines are effective against it, and given how contagious it is, that all will lend itself towards this whack-a-mole zero COVID policy continuing. So the authorities are worried. They're talking about stability all the time now, Lisa, but what exactly they're going to do to rev up the consumer, I think, remains to be seen.
What would happen, and if they did not inject a little bit more stimulus into the economy and stuck with their deleveraging policies?
Oh, pressure on the real estate sector, no doubt about it. We know the developers there are creaking, so some kind of relief is expected on that side of it. But this story will be less about central bank and more about government spending, I think, Lisa. Most people now are talking about, additional borrowing at local government level to put into infrastructure projects, for example. That's where a lot of the support is going to come. But, that won't necessarily turn around the virus story either. So we can talk about, spending to on infrastructure projects and kind of rev up that side of the economy. But it's so critical now in terms of how this virus does play out and how effective the vaccines are against it, because China's pursuing the zero COVID strategy, and that's determining all else in the economy.
And what's the body language of the Western banks in Hong Kong after 12 and even 18 months of just massive and historic turmoil? What's the day-to-day language that you see?
Well, there is obviously a lot of fatigue in Hong Kong. I mean, we're in a unique kind of situation. Tom, on the one hand, we've got this zero COVID closed border strategy going on, which clearly means that life on the ground is pretty good at the moment because the virus isn't spreading. That obviously yields public health dividends and it yields economic dividends. But the flip side is that this is a global finance hub, and travel is now severely restricted, both in terms of actual airlines connecting to Hong Kong and obviously in practical terms and in terms of how people can travel, given the quarantine rules that are required when they come back here. So, look, the mood is definitely frazzled. People are jaded a bit. I think everyone's just watching and waiting to see how Omicron plays out. That's obviously the big variable and wild card for next year. But, I should acknowledge that the virus is under control here, Tom, so there is obviously a public health aspect to that as well.
And thank you, sir. You stay safe. Thanks for staying up late into the evening for us.
Yeah.
Ed Karen over in Hong Kong on some of the data in China and more. Some of the data in the UK today, north of 5% on CPI in the United Kingdom. Deutsche Bank just out with one, Tom. UK inflation to peak above 6% in April.
Why is 6% inflation there different from here, John? What's the distinction?
Not necessarily too different, Tom. There's certainly an FX impact in the mix as well. You pointed out we've come down from 142 earlier this year to about, what, the low 130s
there's
on
adjustment.
sterling. But it's the same story. Reopening, supply chains, all of the above.
Javier Blas of Bloomberg Opinion, congratulations, Javier, on that different tone, puts out a killer map, John, which you've discussed with me before, and I've laughed it off. It's not funny. Utility rates across the continent in England are terrible. How does that play in?
And it's something that a lot of people worry about. It's the number one thing, Tom, that my mum will bring up on the phone with me. Not the cost of gas, the cost of electricity. Just all the time we'll come up on the phone. And when I say gas, I mean petrol, domestically, of course, in the UK, Tom. It's the cost of fuel in the house.
Okay, Bond. Lisa, he's folding into a Bond-like thing.
Is that what you think that was?
Because he's got a British accent and talks to his mother. Honestly, I wonder though.
Is that what Bond does?
Bank of England, just going back to that, just quickly to divert back. The Bank of England has a really difficult needle to thread, possibly even more than the Federal Reserve, because right now you are seeing inflation surge at the fastest pace ever, at least over the past 4 months. And some of the inputs they don't really have any influence over. So what do they do? And what's the signal if they don't raise rates?
John, we got a problem.
Go on, what's that?
Darter dogs out there coiffed today. I mean, we're starting to get the holiday images. For those of you on radio, it is a gorgeous Weimaraner coiffed with a bow tie.
Such a cool dog. I'm obsessed with Mike Darter's dog. It's just beautiful. Can we pinch it? Just take it, Tom, just for the holidays.
Just,
from New
it's
York.
a Celine bow tie.
This is
I was going to say.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Here comes the economic data hardly talked about this morning as we count you down to the Federal Reserve. We've got retail sales due. Your equity market up a single point on the S&P 500. Yields on 10s going nowhere at 143.94 with your economic data. Here's Mike McKee.
Good morning, John. Well, we're seeing a couple of numbers out ahead of retail sales. Empire Manufacturing holds steady at 31.9. That's a point up from the month of November, but that is good news. Shows still some strength in manufacturing in this area. Import prices come in up 0.7%. That is less than 1.2% last month. Take out petroleum, and it's up 0.7 as well. So it's not just oil, and oil prices obviously have been going down. Now, retail sales, the big one everybody has been watching for today, we're up just 0.3 on the month. The expectation was for an 0.8 increase. Last month, it was 1.7%. The control group down by 0.1%. Last month, up by 1.2%. We don't know exactly why this is, of course, but it is possible that it has something to do with COVID, although the Omicron story wasn't out till the end of November. But B, it may be that people pushed sales earlier in the year because they were expecting shortages and they wanted to buy stuff while they could. So this brings down the growth path for the second quarter, or for the fourth quarter rather, but it doesn't necessarily mean terrible news yet. We'll have to figure that out and see. Taking a quick look at some of the components here. Motor vehicles and parts down 0.1. We knew motor vehicles sales were weak during the month. Electronics and appliance stores down 4.6%. That is always a surprise at the holiday time because you would expect these things to come out, people to buy more of that stuff. Food and beverage stores, 1.3%. Clothing and accessories, just a 0.5% gain on the month. Department stores down 5.4%.
Wow.
And food services and drinking places, Tom came through, up 1% on the month. So there is the one bit of good news. That's the only discretionary thing really in here. So the only services industry. So that is some good news. Now, we should mention before we go away here, in terms of the retail sales, remember, this is nominal. It's not inflation adjusted. So you've got to take away, you're looking at kind of negative here. If you've got an 0.8 rise in CPI during the month of November, then you're looking at a negative number for the retail sales.
I think it was Bank of America that said Christmas came in October. There was a feeling, Mike, that maybe we brought forward a lot of that. We can build on that in a moment. Yields come in a little bit at the front end through the belly. We're down about a basis point on 2s to 65 basis points. On 5, down about a basis point to 122 on 10s. A similar move down to 143. Equities hanging in there, positive 0.1 on the S&P 500. Tom, I do wonder on any other day whether we'd see a bigger move in this market off the back of these numbers. They've just so happened to come out. on Fed decision day.
Of course, to move from retail sales to the Fed meeting, and we'll have our coverage this afternoon as well. Michael McKee, one more question, if I could, to you before we get to Professor Rogoff, and that is the spirit of retail America. Remind us, it's 69% of our economic pie. Am I close?
You're close, roughly. It varies by a
Is
percent.
Amazon in those statistics?
Amazon is in the statistics, but it's broken out as sort of non-store retailers, which was flat. So that is an unusual statistic for that category as well. Again, it could be that everybody went shopping in October, expecting there not to be anything to buy.
Maybe it's Celine.
Mike McKee, Tom, let it go. Mike McKee, thank you, sir. That's a sizable downside surprise, Tom.
Yeah,
going into the
is.
Fed a little bit later.
Yeah, well, the revisions were upward a little bit as well. Right now, this is a great joy. He's one of the original guests to give us support on economics, finance, investment, and all of international relations. Kenneth Rogoff of Harvard University joins us here, and of course, with his public service to the International Monetary Fund, a good tour of duty there a number of years ago. Ken Rogoff, I want to play right now for you and for our radio and television audience the comments of Adam Posen at the Peterson Institute on a need to lift inflation. Let's listen.
One of the problems that we didn't foresee when we put in place inflation targets was we assumed, it's in the books that we wrote, we assumed that you would be able to reset the target as economic knowledge and circumstances change it. We've never seen targets get raised for inflation targets. We should be opportunistically reflating. We should be saying, okay, inflation's now above 3%, let's re-anchor it there.
Ken Rogoff, off your important book, one of my books of the year, The Curse of Cash. Should we fear the curse of inflation?
Well, you know, it's not a crazy idea. I think it's a second best idea. By far the most elegant long-term solution as cash is marginalized is to move to effective negative interest rate policy. But it's not crazy. But I mean, the timing would be a little bit awkward right now. I mean, this isn't a gradual rise of inflation, 3%. They've lost control of the game here. And I think they kind of need to demonstrate they can get it back. If it's still high in 3 years or 4 years, it might be. I mean, I think this conversation will come up, although I have to tell you, Tom, if Lael Brainerd had been appointed Fed chair, she was pretty sympathetic to this idea. I have a feeling Jerome Powell might listen to it, but won't be.
Who lost control of the game?
Well, I mean, you know, the positive spin on policies simply that they were buying insurance. Things turned out much better than we thought, the vaccines, the recovery, and so there's inflation, and it's sort of good news because it could have gone a lot worse. We could have had deflation. But I think that story is getting harder to tell. You know, really starting 6 months ago, I think it was getting kind of clear that wasn't where we were. And the stimulus, particularly the March stimulus that Congress and the Biden administration put in place, was too much, too late. And the Fed really had to push back. But then again, we wouldn't be talking about Chair Jerome Powell now. We'd be talking about Chair Lael Brainerd. I think with that hanging over his head, he really couldn't do much.
Ken, let's dovetail your seminal graduate work with Maurice Obstfeld with what Stan Fisher wrote in 1998. In the system that Jerome Powell's in right now, does he need to fear instabilities or jump conditions as central banker of the world?
Well, I think we're talking about inflation. That tends to move gradually. Now, I know it hasn't felt very gradually in perspective, but when you look at, you know, the great hyperinflations in Latin America in the 80s and 90s and the new Soviet republics, I mean, it actually takes a while to take off. It doesn't happen overnight. But, you know, you need to react at some time. Now, if we're talking about a crisis, if we're talking about another banking crisis, corporate debt crisis, that can come much more suddenly. I think emerging markets and developing economies are just an accident waiting to happen now. And if we're talking about the Fed being behind the curve, the International Monetary Fund is perhaps even more so. But I think right now, if we're talking about inflation, there is time to act. It doesn't mean that the longer you wait, it doesn't get longer and more unpleasant to unwind it.
I want to double down on this whole idea of an accident waiting to happen, Ken, in the developing world. How much does that really hinge on the idea of a Fed that most people think will be able to have controlled rate hikes, but some people worry have gotten a little bit out of control and are going to have to hike much more quickly?
Well, it's certainly very sensitive to the hiking more quickly scenario. There are many countries that sort of have access right now suddenly wouldn't. That would really be catastrophic. And I'm not talking about a 4% hike. Just if they had to hike by a full % next year, I think that would trigger problems. But there are already a lot of problems in what we call the frontier emerging markets. Countries, obviously Argentina, Lebanon, have defaulted, but you could look at countries like Egypt, Pakistan, Ghana, really are, have very high debt, not a lot of market access, double-digit inflation in some cases, very different picture there. And there's not a lot they can do if there's a rapid Fed hike. And again, I think the IMF has been behind the curve on this, sort of not putting any conditionality, which made a lot of sense early on when it was a catastrophe. But as time has gone on, they haven't dialed back. It's very similar to the Fed.
Going back to the Fed, Ken, there was an implication in your comments earlier about how Fed Chair Jay Powell, had he been more honest in his assessment 6 months ago about how he saw the economic picture, he would not get renominated. What does that say in terms of how political the Federal Reserve is right now and how much market participants can trust the messaging that they're putting out there?
Well, there's always pressure on the Fed up to the reappointment of the chair, so that's not something new. Donald Trump was, pressuring Janet Yellen in that period. I think she resisted more. But the Fed has become very politicized. It's a reflection of our society. It's a reflection of what they live in, what they have to put up with. And I think Jerome Powell is going to do his best to steer away from this, but it's hard. Biden has a lot of appointments. There's all kinds of indirect pressures they can put on. I certainly, we've seen a period where a lot of academics have said we should have fiscal dominance. Federal Reserve policy shouldn't do that much. Fiscal policy should take over. That's been actually almost a central theme in a lot of research we've seen. It's nuts. I mean, fiscal policy is very political. It should look at long-term growth, distribution of income. We're trying to manage cycles. Look at what happened in March. I mean, it's a perfect example of fiscal policy coming in too late, too much, wrong timing. And who knows, we may end up tightening now more than we need.
Ken, I want to go to something that you know better than most. Tom and I get some hate mail sometimes, and a hate mail I had in the last 24 hours was, why don't you use the H word, hyperinflation? Why are you scared of it? Why aren't you using that? And I was just thinking, Professor, if you could distinguish between problematic inflation, the mid-single digits, the high single digits, and the H word, and what happens when we cross that line and lose faith in the underlying means of exchange. Ken, can you walk us through that dividing line?
So, we put having a hyperinflation at something like 2,000% per year inflation, not even 100%. The United States, I think, peaked, if you look at annual inflation, around 13% back in the 1970s. The UK and Japan went over 20%. That is not hyperinflation. Venezuela's had hyperinflation. Zimbabwe in 2008, 2009, millions of percent inflation. Hyperinflation's a hyperbolic word. But on the other hand, let me tell you, if we got to 13% inflation for a year, it would feel like hyperinflation in the United States because we have very complex financial markets. They're not built for this. I think we could well see inflation stay up at 3.5%, 4% in a couple of years. I mean, I don't know that it's the modal outcome, but it's quite possible because I think as they try to start raising interest rates, they're going to talk tough. Debt is high. Corporate debt, public debt, the stock market, housing prices, you name it.
Yep.
That wasn't the case in the early 1980s. I worked at the Federal Reserve under Paul Volcker. He was very brave, but he wasn't going up against that.
Professor, this is a massive change, and Tom, you and I have talked about it. It might not be hyperinflation. We're nowhere near those conditions, but something double, triple, two 2 we used to, Tom. That's a massive change. I'll have this conversation a little bit later on the Open with Priya Misra, Bob Michael, and Jean Bavin. Great lineup going into the opening.
Yeah, I really want to know, John. I really want to know where Priya Misra is.
If we're at 3 or 4, in the words of the professor, Tom, in a couple of years' time, we're still up there. How does that change things for this market?
Very much. We continue with Kenneth Rogoff and welcome all of you on radio and television. We'll do equities here in a moment on this Fed Day. Dr. Rogoff, as you mentioned Paul Volcker, I want to go back to the courage of 1979. The doom and gloom crew wants Volcker courage right now. I don't hear that from you, that is needed right now. What is the prescription, not only for 2022 for the Fed, but what kind of courage is necessary here for our monetary economists, our leaders on this theory?
Well, we're in this pandemic where there's a tremendous uncertainty. I think in 1979, it was really pretty clear what would happen. There was an amazingly broad consensus that the Fed needed to do something, and the politicians pushed back against it. And I'm not sure Jimmy Carter knew what he was getting into when he appointed Paul Volcker, but Paul Volcker did the job, and Greenspan followed up, et cetera. Today, there's obviously a lot of lingering uncertainty. I mentioned at the beginning that everybody was, the Fed's terrible, they're idiots. Well, it's Monday morning quarterbacking. I didn't know when the pandemic broke out that we'd have the vaccines as quickly. We didn't know how much we'd adapt. There were predictions about it, but the modal prediction was for much worse. I think the mistakes have come, more recently. Where he's going to have to be courageous, he's going to raise rates next year. It seems pretty likely to me. Where he has to get courageous is, things are going to start seeming a little shaky. There's going to be pushback, and yet inflation is still going to be up. And, what if he needs to take rates by 2 years from now to 2%? That could be, it's easy to write on paper, but that could be very, very difficult to steer politically.
Ken Rogoff, Lisa and I would like to shift the conversation to this mystery of 2021, which is the ascent of Bitcoin. You were out front on this with the curse of cash, looking at cash of the system. You looked at negative interest rates as well. Your thoughts on the enduring ability of Bitcoin and crypto, and I take this off of Alan Hour's work at the Bank of International Settlements. Fold Bitcoin into your seminal work, The Curse of Cash.
Well, I talked about it extensively. The last part of my book's all about central bank digital currency and cryptocurrencies. I think a thing I would say I got wrong was the pace at which regulation would react. Regulation does need to react, I think, much more dramatically than it has. I suspect eventually pseudonymous cryptocurrencies are basically going to have to get banned in the advanced economies. And that was sort of a prediction of my book, because it was just too easy to avoid taxes, too easy to do stuff. I mentioned before the program, I'm doing a lot of research on these issues now. But boy, the dynamics of regulation, Bitcoin ETF, allowing the big investment houses to set up, funds in cryptocurrency, pension funds to invest. An analogy I like to make is a little bit like, what if you found a diamond ETF was a really good idea? Oh, okay, I want to invest in it. And then what if I tell you it's blood diamonds that you're investing in? If you look at the actual uses of pseudonymous cryptocurrencies, I don't think it's something we can tolerate. But I got it wrong 5 years ago at the pace at which this would happen. It's going to drag out for a long time. And therefore, they can have a lot of value because, oil and gas have a lot of value, even though we think we won't be using them in 40 or 50 years.
Lisa, this is incredibly important. That thud you just heard, Lisa, was James Dimon falling off his chair down on Park Avenue.
Although perhaps
he has to deal with this. Lisa, this is incredibly important, how the regulation, how Gensler hasn't stepped in.
Well, and he has been pretty vocal about the need to do so and trying to be a little bit more aggressive going forward. But there has been a feeling by the government to not want to stifle innovation at a time when the technological advancements of the United States have really driven a lot of the growth. Professor Rogoff, there is a theory out there that when you pull the tide back at a certain point, there is a lot of malfeasance. There are a lot of very frothy spots that would get knocked out, and that the Fed cannot allow that to happen because that would torpedo an economy that it has very few tools left to accurately prop up. Do you agree that the Federal Reserve in the modern incarnation is going to be vastly more involved and activist just by virtue of the potential consequences if they're not?
So you're going beyond cryptocurrency.
Yes, I am.
Becomes
correct.
Systemic. Yeah, I mean, I think I don't know if it makes them more activist or less. I mean, I think in the immediate future, the next few years, the difficulty for the Fed is that they might need to raise interest rates cyclically quite a bit. And frankly, I think the 300 basis point drop in real interest rates that's happened since 2007, looking at the 10-year, I think part of that's trend, maybe a third of it or a sixth of it is trend, but some of it's not. And they're likely to have to retrace some of that. And at these market levels, you can just go down the asset list of everything. It's going to be very painful. And that's why I suspect that despite the tough talk that we're going to get now, when things start pushing back, they're going to find it harder to scale back than they think. I'm not saying, again, I'm glad we're getting out of this. I'm glad the economy is recovering, but they're in a very difficult spot.
Ken Rogoff, thank you so much for an extended conversation with Harvard University and, of course, The Curse of Cash, wonderful, as well as other work as well. Right now, we shift to the equity markets. We do this after Alan Ruskin, David Kostin, and Professor Rogoff. We go to Professor Gina Martin-Adams, our chief equity strategist at Bloomberg Intelligence. Gina, Poonam Goyal did her outlook for retail for 2022, and I didn't hear her say go to cash as well. How do you do the fourth year of a bull market? How do you prosecute the thinking?
Yeah, I think it's all about the moving parts of continued strong growth, but tighter interest rates and tighter Fed policy constraining the potential of the equity market. So it really depends on how fast we can grow earnings. I mean, we talk a lot about the Fed, and the Fed is certainly important, and interest rates are certainly important as a discount mechanism for deriving the value of equities. But frankly, what matters most for the direction of equity prices is what's happening in the economy and what's happening with earnings growth. And our models say we could get 15% earnings growth next year to help offset some of that pressure that is inevitably going to bubble up on the multiple with respect to the Fed.
Buried in the Goldman Sachs deck from David Kostin was one single comment. You got to stay with high growth, high quality, high profit. He didn't mince any words about that. Do you share this wickedly barbell strategy, or do you go a different way?
No, it's very interesting because it has changed in our modeling, both on the factor side and the sector side over the course of the last 6 months. We've started to migrate toward lower volatility from higher volatility. What does that mean? Sort of the meme stocks that really carried a lot of 2020 and 2021 returns start to come under some degree of pressure as we move into an environment of tighter interest rate policy, most likely. Some of the narratives that really worked to drive equity markets shift, and it becomes sort of more of a classic investment environment, right? You start to take away a little bit of that liquidity, and you start to think a lot more about cash flows. You start to think more about things like quality and less about just buying on the cheap and buying all the junk to get the big rally or the big rip. So I do certainly sympathize with that. In our sector strategy, we're also seeing something similar, where within the U.S. economy, the sector strategy is still working in favor of stocks in the energy sector and the financial sector, highly cyclical groups, but also in favor of some defensive groups like consumer. Some of the consumer names started to bubble up a little bit. Technology bubbled up. Real estate is toward the top of our scorecard, where industrials, materials, and some of the hyper-cyclical names are back at the bottom. So a bit of a barbell certainly can be appropriate in sector strategy.
So this, Gina, explains why we're seeing sort of muted expectations going forward for the headline number in the index. But you talked about the Fed, and I don't want to let the Fed go. Yes, earnings are robust, but everyone is counting on a gradual rise in interest rates. The Fed will not hike rates quickly. Can you give us a sense of how much that's baked into the assumptions that the S&P headline level will in fact rise, say 8 to 10%?
Yeah, it is a huge part of the assumptions because it's foundational to your modeling for the valuation multiple. At the base of our valuation model is the 2-year Treasury rate, and adding on to that to adjust for an equity risk premium, we use the yield curve. curve. Now, the idyllic situation is what most of the consensus is suggesting, and that is some yield curve flattening over the course of 2022 as a result of the Fed's movements. Anything else could create a much greater degree of volatility on the multiple. For instance, if we get something where the bond market rallies and we see long-term rates rally substantially as the short end moves higher, as the Fed starts to guide toward tighter interest rates, that's a pretty significantly different scenario and has historically been much more difficult for stocks than that sort of idyllic flattening environment that the consensus is expecting. We could see multiples contract in that type of environment all the way down to 17, 18 times from above 20 times. And unless you're getting very, very rapid earnings growth, that means a flat to down equity market. So we are certainly sensitive to what's happening at the Fed.
Gina, thank you so much. Gina Martin-Adams with us with Bloomberg Intelligence. So just a whole team of people working sector by sector, stock by stock on what makes up this market. With all of this, the great conversation with Gina Martin-Adams, Lisa, and of course with Professor Rogoff, we didn't say enough about retail sales. I believe I saw a negative statistic.
On the control group, this to me is actually quite significant. It raises a question of how much inflation is weighing on consumers' willingness to buy more stuff. And the fact that we saw such a big disappointment suggests that it is starting to weigh. And to me, I do wonder how much this factors into a lot of the estimates that really have all called for consumers to remain robust. Just to give you a sense, though, this is the smallest advance on the overall retail sales number in 4 months, just to sort of give the trajectory going forward.
To me, I'm going to go real nominal. And I think what Michael McKee said, those are nominal statistics. So when you take out inflation, you really wonder how it adjusts. And again, with the inequalities in America, we make jokes about Celine and good morning to all at LVMH and all that. But the bottom line, Lisa, there's partitions here to America, partitions to retail, and as Gina Martin-Adams said, huge partitions to the future of equities.
When you start looking at 7% CPI or a 6.8% increase in consumer prices year over year, this is a new paradigm. When you go to the grocery store, people feel it. When you decide whether or not you're going to buy a dishwasher or a stove, this has been something that's been ongoing for a whole host of reasons. But I just, to me, the idea that margins will continue to increase, to expand as companies are able to pass along more and more of their price costs is something that needs to be proven.
We've got to go to this breaking news right now and speaks to what Lisa's been way out front on. JP Morgan announces that their healthcare conference will be virtual. That seems like a headline from August of 2020.
The Moderna CEO didn't want to be seen at the conference in person. So it's a healthcare conference.
Everything we talked about today, that's the bombshell headline to me. There is a Fed special this afternoon. The Fed decides. Rumor has it John Farrell will be there. This is Bloomberg.
Years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops tanks, guns, UAVs. Clearly, neither side are taking any chances.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Your Fed decision just around the corner from New York City this morning. Good morning, good morning. Your equity market negative just a single point. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue.
Hello, traders. Again, we need to place stop for euro. Let's see if I'll be able to place stop at 112.72. If not, it moved rapidly down. So I see no. We will wait. We need to place basically stop on our position. We need to hold profit. Usually we do 2 pips above our open position. But right now, as you can see, it moved down. So we will see false alarm. I'll speak to you later, guys. Okay?
Point. A fantastic lineup this morning. Joining us now is JP Morgan's Bob Michael, BlackRock's John Bavan, and TD's Priya Misra. Let's just start with base case expectations, as we always do. Priya, first to you.
So we're looking for them to accelerate the pace of tapering, ending tapering by March of next year. But I think what's more important is how does Chair Powell explain it? Is it policy flexibility, inflation vigilance, or is it that their base case outlook has changed and we're more in the flexibility camp? I think, you know, whether they end up hiking next year or not is going to depend on the economy next year, on the inflation trajectory. Today is about let's have the option to hike if we need to, but we actually don't think that they're going to be able to hike next year because we do expect that fiscal drag to start to show up. But yeah, today is about how they sell that acceleration of tapering.
You've got an outlier call, Priya. We're going to revisit that in just a moment, looking for that hike, not in 22, but in 23. Bob Michael, I want your view first. What is it going into this one?
Well, for us, the most important thing are the dot plots. And the 2 things we want to see from that are when the committee expects the first rate hikes. We think we'll see 2 or 3 in the dot plot for 2022. The first one more likely to be June than September. The second thing we want to see from the dot plot is where they expect neutral to be, or where do they expect to pause in this cycle. We think it's going to be somewhere around 2.25% to 2.5% in 2024. Those are the things we're looking for.
On the dot plot, Stephen Stanley of Amherst Pierpont agrees with you. He writes the following: the dot projections will be the most important thing. While the statement language can be vague, the dot projections offer something very quantitative and concrete that market participants can sink their teeth into. Your view on this, Jean Bavan, what you're looking for as well, please.
the most important thing for 2022 for the Fed in our mind is how they're going to be interpreting the employment side of their mandate. And I think today what's going to be key to see whether they provide more clarity. And broad and inclusive, I guess nobody really knows what that means yet for the Fed. You know, we'll see how participation improves over the course of the next few months, but I think it's going to be hard to make the case that the employment side of the mandate is reached before June. I think that gives us a June to September window to see some hike. And so I think I'm pretty much in the same ball camp as I've heard my colleagues so far. It's you know, starting next year, it's going to be pretty shallow, the shallowest hiking cycle we've seen in decades.
We can spend some time talking about the dot plot. I just want to think about emphasis in the news conference as well. This was something that Steve Englander of Standard Chart wrote about. Mellon Investments say the statement has been displaced by Powell's opening remarks at a press conference. He's going to walk away from the dots as much as he can. And Bob, I want you to weigh in on this. From Steve Englander, he writes the following. If he downplays inflation and policy rate forecasts and delinks rate hikes from the end of QE, these would be indications that he still sees the possibility of an inflation pullback before a hiking cycle becomes well entrenched. Never underestimate the power of emphasis in a central bank news conference. Where do you think that emphasis is going to be, Bob, for Chair Powell today?
I don't think he can de-link rate hikes from tapering from inflation. And right now, we're looking at fantasy numbers in inflation. We're looking at a producer price index in the U.S. of 9.6%. Woke up this morning and saw the retail price index in the UK at 7.1%. The inflation genie is out of the bottle, and bond market participants want to see him address that. I think some of the narrative I've been hearing is he's got to balance the headwinds that Omicron present with this enormous inflation. I don't think he's in any position to do that. It's not as though they're somewhere near neutral, where they've stopped expanding the balance sheet, they're just reinvesting, and they're up around the zero real Fed funds rate. They're so far away from any argument about what neutral looks like. They've got a lot of work to do.
Bria, I know that you think they can de-link the taper call from the rate hike because you don't expect a rate hike until 2023.
So I think Chair Powell is going to try and de-link. It is going to come down to, you know, how the economy, but the market sees them absolutely as linked. So I'm with Bob there. I think if he's unable to really talk about not hiking until maximum employment is reached, I think that's the key. You know, is the threshold for the first Fed rate hike reaching maximum employment? In which case, I think he's going to try and that's the way they can actually de-link. If he can talk about, look, if the inflation numbers stay this high, even if we don't reach maximum employment, we have to start to edge off zero. I think the market's going to absolutely see that as vindicating market pricing. You know, the market's pricing first rate hike in May of next year, which I think is pricing in this acceleration of taper and the Fed being forced into hike before maximum employment is reached. So the market will see them as being linked. I think it's going to actually come down to the economy next year. And I don't want to extrapolate from CPI or PPI right now because, you know, is this a normal recovery? This is such a goods inflation-led inflation number that if we do start to see, and Omicron's going to make it much harder for the Fed. And so I wonder if that's another way he can de-link that, look, we are ending tapering, but if Omicron does provide that labor market, you know, slows down the labor recovery, the Fed can be patient on hikes. I also wonder, does he have to talk about balance sheet runoff? If the Fed is talking about hiking by the middle of next year, balance sheet runoff is a few hikes after that, and they've been very silent on that. The market's always forward-looking, right? So we price in the hikes, and then we have to price in balance sheet runoff, and that could actually have a big implication on the long end, on equities, frankly, and general risk assets.
We always think about the what next, and so much of this is so well discussed. How well priced is it? Jean Bavin, we know the story now. We're expecting an acceleration of the taper. We're expecting 2 hikes in the dot plot next year, 3 in the year after that. Jean Bavin, just how high is the bar for a hawkish surprise going into this call a little bit later?
Yeah, the bar for a hawkish surprise is not that high. I think, you know, I would say that over the course of the last few weeks, with Powell's comments, you know, he's been repositioning himself towards a more of a hawkish stance. I agree with Bob that, you know, this variant doesn't call for or doesn't play into, you know, a massive growth story that would delay or derail the hiking cycle in a material way. I think, in fact, it's more of a supply shock type nature where they need to think about the inflation implication as well as the growth. So I think given that the possibility of Powell sounding hawkish, I think is not that high. I think as a bar. That said, I think this is going to be a lift-off story. The most important part, as Priya was saying, I think is really the labor side of the mandate and how they talk about it. That's where I would focus today more than how they talk about inflation.
Bob, do you think there's an option here, just on balance sheet reduction, to go there first before you reach for rate hikes? Is there an option there available to them?
No, I don't think so. I think that would be a shockingly hawkish measure, and they'd have to see something in inflation that really panicked them. If you look back at the last cycle, they waited until the 5th rate hike before they started to run down the balance sheet, and that was the 5th out of 9 eventual rate hikes. We think they learned something from the last cycle. They could probably start the balance sheet reduction a bit earlier, but I don't think they'll front-run rate hikes.
When you compare this to the previous cycle, Priya, we have to build on something that was mentioned a little bit earlier on, a few minutes ago, just how high that interest rate can go. There's an obsession over liftoff. Let's talk about destination. How much work do they need to do here, Priya? Where's this one going?
Right. So, I think the market's been looking at this terminal rate. That's only 1.5%. I actually think I don't think the market's pricing in a policy mistake. We've just priced in the start, May of next year, and we've priced in 3 hikes over the first year. I think beyond that, it ends up being, why we think those rates are low is not a view that the fundamental long-term growth of the economy is much weaker or that the Fed is going to make a policy mistake and hike too much. I mean, look at where 10-year real rates are, extremely accommodative. So the Fed can hike a few times, and I don't think it's going to really move financial conditions that much tighter, which means they're going to have to keep going. But the market may not reprice that. I know the long-run dot will probably show 2.5. The market's ignored it this entire time, and I think will continue to ignore it even today. But how much do they have to hike? We think closer to 2.5 is where they have to go. What gives the market comfort on that will actually have to come down to the economy, and how does the economy, fare next year, as opposed to anything that the Fed can communicate. They can keep telling us that they're going to hike, and I think the market will call their bluff on this and keep that terminal rate pricing low.
And Bob, how far do you think they can take it?
John, what's happened? Really, what's happened? For 30 years, I've been hearing that central banks, their biggest problem was fighting disinflation. Nobody knew how to do it. But if inflation ever came back and we had high inflation, we had the roadmap, we had the blueprints, we knew how to do it. Well, here it is. And what I'm hearing from Priya is that we're too frightened of actually doing what's necessary to put the inflation genie back in the bottle, to hike rates dramatically, raise the cost of financing so that these higher prices can't be supported. Yes, it could lead to recession, but at least you put the inflation genie back in the bottle. I guess in the end, I see both on the fiscal and the monetary side, no appetite to do that. So, yeah, I don't see a terminal rate getting much above 2.5 to 3%.
Bob, you just said something really interesting there. You used the word frightened, as if they're scared of it. And then you used the word recession, and implied that maybe a recession would be worth putting the inflation genie back in the bottle. I want to build on that, Bob. Why do you think that's a fair exchange?
Because the difference between today and when Volcker was running the Fed and raised rates from 5% to 20% in 5 years is that the central banks have become dependent on financial conditions indicators. So they look at people like us, and if we throw our rattles out of the pram, then they get panic-stricken that could lead to recession because that's what their model tells them, and they back off. And I think that's how we've gotten into the position we're in today.
Well, financial conditions, Jean-Baptiste, are still extremely loose. We have a Federal Reserve that is still very accommodative. And to Priya's point, real rates still incredibly negative as well. The thing that I've been thinking about, John, it's barely got talked about over the last month or so. They're going to make a call today to accelerate the taper. They might indicate they're going to hike interest rates next year as well. What difference would it make, Jean-Baptiste, if they do that? What's the objective of policy, and what will it actually achieve?
So So one thing I would stress here, and it's maybe a bit slightly different take than for what Bob was saying about the comparison of trying to deal with the low inflation, and now inflation is here, we know what to do. We're facing an environment which is unusual. I mean, this inflation is driven by supply shocks in a very significant way. We haven't seen this kind of combinations for many years. And then when central bankers are faced with supply shocks, it's not as easy to slam on the brake. The implications, you will have to destroy demand effectively to contain this inflation at this juncture. The calculus is a lot more complicated. That's why I think, I'm not sure if it's about being frightened. I think it's really about a different kind of calculus where you don't want to necessarily respond to this inflation the same way as if it had been an overeating economy, demand driven. I think that's going to be part of their thinking. But I do think that one of the biggest risks we see to our scenario in 2022 is if they wake up one day and they feel they have to slam the brake. I don't think, I mean, this is Bob's point as well. I think it's not only being frightened. I think the reality is that the markets are levered to this low rate environment, and it's going to be disruptive. So even if they muster the conviction to go on a very steep hiking cycle, they're going to wake up to something that is going to be a bit more disruptive.
John, Bob, Priya, sticking with us. We'll talk about another disruption next. Coming up, the spread of Omicron, fueling the vaccination effort and a return to mask mandates.
If we want to end this pandemic, we have to get first and second doses into people in the US, the UK, and all around the world.
More on that conversation still ahead from New York on this Fed Decision Day. This is Bloomberg.
When your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is really about reaching the unvaccinated, and many policymakers have given up, so they continue to boost the people that are already vaccinated, but that's of much less value than getting first and second doses into people. And I think that they've recalibrated to focus on cases because they've given up on the unvaccinated, and I think we can't give up on the unvaccinated.
The spread of Omicron fueling fresh mandates across corporate America. Apple re-implementing COVID protection policies, running the following. We now require all customers join our team in wearing masks while visiting our stores. Proactively monitoring and managing occupancy will enable engagement at a distance that feels more comfortable. With us now for more is Mike McKee. Morning, Mike.
Morning, John. Well, the Fed has to worry about Omicron. It's the flip side of the inflation debate. If they start raising rates too fast and the disease catches on too deeply, then they've got a problem in the economy. And here's what we're seeing: COVID cases surging again. Sajid Javid, the health minister in the UK, said there were 200,000 cases a day because they can't identify them all necessarily. That's going to be a problem in the United States as well. We're also seeing fiscal support waning. We had a big rescue plan when the first waves of COVID came through, but we don't have that now. And there are early signs that there are disruptions, particularly seeing it in the athletic events. The NBA has 34 players in protocol. Games are being canceled. 75 NFL players now tested positive. Remember when all that happened back in March of 2020? So what does the Fed do about that? Well, at this point, they're looking at retail sales weak. They're looking at inflation high. How do you balance those two things out? Which of those two lines do you support? And that's going to be key to how far the Fed goes today. Now, one thing the Fed has been looking at is that each wave of the pandemic has been less of an impact, has had less of an impact on the overall economy. The blue line is the stringency index, how many lockdowns and mask mandates we have. It's gone down, and retail sales have hung in there. So does the Fed have to move, or can they wait? That's the debate that's behind the idea that, John, that they are going to give themselves optionality and increase the taper, but not promise any rate increases.
It might be key, and to work out how this data story evolves through next year. Morgan Stanley wrote this on supply chain issues. We worry that increases in supply will reveal the severity of double ordering, which we believe is pervasive across most industries. The result will be a shift inward of the demand curve and a return of discounting at a time when many businesses are counting on pricing to offset the higher cost they're now having to absorb. Bob, Sean and Priya are back with us. Sean, I want to throw that one at you. How you think the supply chain issues will resolve themselves through next year, just your base case expectations?
So I have to start by saying that, you know, this is a restart dynamic we are going through after having shut down the economy. We have no historical precedents whatsoever to benchmark or to compare to. So I think it's very difficult to have I think you know, people that have a high conviction on when it's going to be resolved tells you more about themselves than the supply chain. So I think we need to be a bit humble here. I think ultimately it gets resolved, of course, over the course of 2022. I think you know, it's a lot harder to restart supply. We're seeing that. I'm not sure I would go all the way to think that we're going to turn into a deflationary story over the next few months, as you've just heard. But I think it gets to be resolved, you know, over the course of 2022.
Bob, this is a really, really difficult one to call. How the inflation story evolves through next year. You get that downside risk to the inflation number, the headline number, from supply chains resolving themselves, that upside risk from rents. How do you balance that story, Bob, from your standpoint into next year?
Well, in terms of the supply chain and double ordering, I wouldn't mind getting my first order before worrying about a double order. I haven't received any of my first orders yet. Our look at supply chains and seeing what's going on at some of the ports, this is not months or even a couple quarters to work out. This is a couple years, and that's just on the good side. We haven't even talked about the labor supply chain. I think there's another structural problem there. We may actually be at full employment. And you started off with Mike talking about Omicron and the potential headwinds that the Fed has to weigh. All of it looks somewhat manageable to us today. And in fact, I'm in the office, I'm broadcasting from the floor, I've got my mask. As soon as I walk off this chair, I'll put my mask on. I think we've learned to adapt to it. For us, the seismic event would be school closures. That would send tremor through the markets, because the knock-on effect of all of that, we know from the past, would be something pretty dramatic. And I think that's the one thing the Fed needs to worry about.
I think a lot of parents, Bob, would agree with you as well. Not just the Fed who needs to worry about that one. I know a lot of parents who are also very concerned about that one. Priya, I wanted to give you the final word here, because for everything we've just said in this segment, you believe the Fed's going to wait. Where do they find that patience?
I think it comes from, you know, a sign that the labor market has a long way to go from full employment. Now, we saw that in the last labor report, participation began to increase. Is that a sign that the Fed will grasp onto to say, look, people will come back. We just need that service demand to pick up. Now, Omicron could delay that, because if people are nervous about mingling, or they're canceling social events, does that just slow that service recovery? So, but if there is some evidence that people are coming back, that the savings rate has actually already normalized, there's no more fiscal support, I think the Fed wants that optionality. They also want to control inflation expectations. I'm going to highlight long and inflation expectations are very well anchored. The idea that the market's pricing in a Fed policy mistake is actually the market saying inflation's not a long-term problem. So as the Fed gets more comfort with that, they'll end tapering. But to hike, that's a high threshold, and I think that's where they can be patient to see how the economy is evolving next year, and does the fiscal drag start to slow demand down? We've talked a lot about supply, but what if demand starts to slow down? And I think that'll give them the patience to say, look, we can go anytime, but what's the rush?
We're going to keep building on this. Priya, Jean, Bob, just a fantastic lineup. Coming up on the programme, I'll bring you the morning calls then later. If you've got exposure to banks, big tech, whether you like it or not, you've got exposure to rates. And we have the perfect panel to talk about that and what it means for risk assets very shortly. From New York, this is Bloomberg.
提前的就是步入工作岗位，然后对这个工作更加熟悉，然后调整好心态，就能够在赛时去一个更加自信、更加昂扬的一个姿态去迎接来自世界各地的代表团的外宾们。
Let's call it 4 minutes away from the opening bound from New York City this morning. Good morning. Your equity market totally unchanged on the S&P 500. Going into that Fed decision a little bit later this afternoon. That's the price action here in the morning calls. First up, Citi upgrading UPS to a buy. The analyst expecting pricing power to return as the year progresses. Next up, Goldman downgrading Sherwin-Williams to neutral. The analyst seeing limited room for notable upside following the stock's recent outperformance. And finally, Benchmark cutting its Netflix price target down to $470. The analyst citing inflation concerns and the potential impact on its valuation. That stock of $5.99 in the pre-market, positive 0.2%. Coming up, we'll talk about big tech. We'll talk about banks. Rich valuations facing the threat of a tightening from the Federal Reserve. From New York City, this is Bloomberg.
world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Well, let's get this session started. From New York City this morning, good morning. 20 seconds away from the opening bell and futures set up as follows. Basically unchanged. On the S&P advancing by just a point. On the Nasdaq down 14. We're negative about 0.1%. Going into that Fed decision a little bit later this afternoon. That's the opening bell. Switch at the border. Get to the bond market. Your 10-year yield topped out at the end of Q1. The back end of March at 177. Right now, 30 basis points lower. To end the year in and around 150 at the moment, at least. 147, yields are higher by 3 basis points on the day. Euro dollar, this could be interesting through the next 24 hours. On the euro side, the ECB tomorrow. On the dollar side, the Federal Reserve later. Euro dollar unchanged at 112.57. Crude down 70 cents, call it 69. We're negative 1 full percentage point to $70 and about 4 cents. In your equity market, it's a flat open, as you might expect. About 30 seconds in, the S&P 500 advancing 0.05%. Utilities leading the way, up 1/3%. Lagging consumer discretionary. John Hancock's Emily Rowland making the case that equities will be just fine, even if we get those rate hikes.
When the Fed is tightening policy, that means that the economy is accelerating. If you're concerned about inflation into 2022, equities are your best hedge against inflation. We think equities can do just fine into next year. We would start to embrace quality more as we head into next year.
Back with us on this story, Bob Michael, Jean Balvin, Priya Misra. John, I want to come to you on that. Equities will be just fine. We're hiking for good reasons. Typically, that's the case, Sean. Is that the case this time around?
So I have a slightly different angle on this one. I don't think it's about the fact that the economy is doing well, accelerating, that and the rates, Fed is hiking on the back of this. I think the story that is constructive, so we end up in the same conclusion, I think it's going to be supportive of equities, but it's really that we're going to see a more muted response to this inflation. So real rates are on the way up slightly, but very muted. And I think that's going to continue to be constructive for equities. That's what we call the new nominal. We think that has played out massively in 2021, and that continues in 2022.
It's something that Jonathan Golub at Credit Suisse talked about. Well, Jay Powell has backed away from the term transitory. There's little indication that he believes inflation is sufficiently entrenched to justify inverting the curve, stifling demand. Put differently, we believe the Fed will avoid such restrictive policy, providing continued support for economic growth and risk assets. Priya and Bob, I want to throw that at you. Just the last end of it, and Priya first, please. We believe the Fed will avoid such restrictive policy, providing continued support for economic growth and risk assets. Priya, do you agree?
Yes, I do. And we're very, very far from restrictive policy. 10-year real rates are close to minus 100 basis points. So whether it's the balance sheet policy or the Fed raising rates, or do they ever go above neutral? I think all of this we're so far priced for restrictive that even if they end tapering and even if they do start hiking, we don't think they hike next year, but even if they start hiking, 3 times next year or in the first year, those real rates being that low is actually very supportive for risk assets, etc. We really need to see if the Fed gets nervous and they start moving those long end real rates higher. That's when I'll get nervous about risk assets.
Bob Michael, same to you, sir.
Even though our path for rate hikes is far more aggressive than Priya's, we see it starting in May or June, and we see 9 consecutive quarterly hikes until you get to 2.25%, 2.5%. Even though that's far more aggressive than Priya's path, the markets will snicker at that. Because even under that path, you don't get to roughly a 0 real Fed funds rate based on their 2% inflation target until 2.5 years from now. 2.5 years from now. Think of that. Yep. Think of all the growth, all the inflation that will happen between now and then. I think the Fed's hand will be forced before that. Once they have to accelerate the pace of rate hikes, that's when you worry about risk assets.
Let's push this story through the equity market a little bit more. The Nasdaq down 1/3 of 1%, the S&P unchanged. With more, let's get to Kelly Lyons. Hey, Kelly.
Hey, John. Well, the prospect of a more hawkish Fed has weighed on equities really across the board over the last several days. But it is true that big tech has been hit the hardest. And that's really true across all of the tech gauges. The NASDAQ Composite, the NASDAQ 100, each down about 2.5% over the course of Monday and Tuesday, while the NYSE Flying Plus Index, which houses the largest of the large caps, and the SOX Semiconductor Index are each down about 3%. What's interesting is that it's software that has been the big underperformer, down 4% in 2 days. Had its worst day of the year yesterday after JP Morgan downgraded 13 of those stocks, the analysts citing valuations and the risk that interest rates rise in 2022. And we know that, John, that more richly valued areas of the market are more vulnerable to higher rates. And that has led to even more underlying weakness in tech than appears just looking at the surface. When you take a look at the technical picture for the NASDAQ 100, only half the members of that index are trading above their 50-day moving averages. So breadth is looking quite weak. And finally, I would note it's not just tech that has lost its luster. So have SPACs, newly public companies, and notably meme stocks, all under pressure recently. Gauges that track those groups down double digits over the last month, and risky areas of the market, John, really getting caught up in the selling pressure as traders are faced with the prospect of a Fed removing support and higher rates coming down the pipe, John.
How much worse could it be? Kelly, thank you. It could be a whole lot worse because, Bob Michael, this story around inflation, 6.8%, has not translated into materially high yields. Your 10 years at 147. I think if we had this conversation at the start of the year and we spout it out for everybody, we got a crystal ball, this is what the data will be, where are 10-year rates? Would they have gone with 146, Bob?
No, I don't think so. And perhaps we're living through another bond conundrum. This reminds me of what Greenspan was talking about decades ago. They were raising rates and the 10-year was left anchored. And I think the dynamics have changed. Back then, it was foreign reserves. This time, I think there's some foreign reserves, and I think the markets are just awash in liquidity. And there are a lot of long-term plans that have a lot of de-risking to do. And people now know that as central banks start to hike rates, the yield curves tend to flatten around the expectation of a terminal rate. And even today, that terminal rate, the debate we're having is it 1 5/8% or is it 2 3/8%? It's not radically different from roughly where we are today.
John, are you positioning for a steeper curve?
We expect some steepening forces to play out because the inflation that is at play, actually, it's more about the inflation than the Fed itself, right? What the right lens in our mind. And we think inflation will settle at a higher level. As we just wake up to this, I think we're going to see an environment that's going to call for some steepening. But one thing I would like to stress, which is where you started, I mean, we've seen in 2021 a combination of positive equity gains with negative bond returns. There's only 3 other years in the last 5 decades where we've seen that. And we expect 2022 to look very similar, and it hasn't happened to see 2 consecutive years ever over these 50 years or 5 decades. So I think we're in a new regime. I don't know if it's a conundrum, but it certainly feels like a new regime, and it's one that I think it's explained by a much more muted central bank response to this inflation, and that's the stories about inflation and how it feeds through the equity landscape.
Jean, that's your line in the research, a new market regime unlike any other for 50 years. Does that just translate then, equities okay, more bond market losses ahead? Is that what you're describing here, Jean?
I mean, at the high level, that's what it has been up to now, and I think we see good reason to expect that in 2022 to continue. And again, that would be very unusual sequence. The risk to that is central bank panicking and slamming the brake, as I mentioned before.
Priya, I want to come to you on this, on that dance between the front end and the back end of the yield curve, and what you're pushing for right now. You have this outlier call on rates. Do you have this outlier call on the yield curve too?
You know, the two are extremely directional. We do have a bit of a steepening bias on the yield curve. And I want to flag, I mean, there's an inflation aspect. If the Fed doesn't sound like it's panicking on inflation, and therefore that lets inflation risk premium rise, there's also a supply aspect. I mean, we have a very high deficit, even next year, even though the deficit is lower this year, we don't have any more fiscal support. You have 1.3 trillion of treasuries to take down next year, with the Fed not buying any after March, assuming they accelerate taper. That's going to have to attract investors from other asset classes. Maybe it's other fixed income, maybe it's other risk assets. And so that's going to push rates or term premium somewhat higher. So we do have I don't know if the curve is the right way to play that, or being short the long end of the treasury curve. I do think that there's that pension demand out there. There's some demand from China, but banks have been huge buyers. If the Fed ends QE, I think banks step away as being a big buyer of treasury. So that's the Fed and banks stepping away, and I think that's going to push those long-end rates higher to attract people to take down the high deficit that the U.S. has to finance.
Well, Bob, let's build on that. You've got to help put that money to work. Let's put it to work right now. Where are you doing that at the moment, Bob?
Well, there are a number of things that we like. We still like credit. We like high yield. We don't think you start to worry about high yield when the central banks begin to raise rates. Any backups there should be bought. You worry towards the end of the cycle when it looks like they've gone too far and you might see a recession, then of course default rates would go up. So high yield looks great. We love bank loans because of the floating rate component of it, and we like securitized credit. We also like credit in Europe, particularly bank debt. And the additional Tier 1 security. So there's lots to buy in credit.
Jean Bavin, final question to you on that as well, if you can respond to that too.
That environment, I think pretty clearly, based on what we said so far, is favorable for DM equities. That's where we think that money needs to be put to work. There's a lot of money to be put to work. I think that's going to continue to be attractive. DM government bonds are going to be challenged as an asset class. So we have a fairly high conviction on the weight there. And we see some emerging market debt as being, attractive in this kind of slowly rising rate environment.
Bob, final question for you as well, sir. Let's do a quick thought exercise. If the Federal Reserve could go back in time, where do you think they'd have policy today? Where do you think ideally they'd like it today? Would QE be over? Would they have done that already?
QE would be finished and they would have started the rate hiking cycle.
Priya, do you agree with that?
I don't. I think QE, I can see the point. Long-end rates are really low. So, but rate hikes, I mean, what about all the 4 million people out of the labor force? So I think hikes, I would still say that they'd want to hold off.
Can I get to a final question for all three of you? Is the year over after that news conference finishes? Do you send the team home? Bob, do they all go?
Yes.
Priya?
You're not putting on any risk, but you have to be around. It's a really illiquid point on the curve of the year, and we have auctions in the next couple of weeks. So no, you have to be around, but it's going to be less liquid. Don't put on a ton of trade.
They're so serious at TD, Bob. They're so serious. Jean Bavin, do you send the team home at BlackRock?
Need a break.
Jean Bavin, it's good to catch up, sir, alongside Bob Michael and Priya Misra. To the three of you, absolutely brilliant on this Fed decision day, and thank you to the three of you for everything you've done for this program over the last 12 months. Coming up, President Biden's spending bill stalling on, guess what, inflation worries.
Why we explain Build Back Better the way we do is to convey exactly the areas to the American public where it will lower costs. Childcare is a huge cost burden on a lot of families across the country, and it will have an immediate impact next year.
More on that next. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
この短期間に一気に上がってしまったので、正直きついのはきついです。先から灯油の単価が上がるよと連絡があったのが10月の初め頃。当初はこんなに上がると思ってなかったんですけど、初めに5円上がる。その先10円。で、その次に3円上がる。で、また今日ちょうど2円上がったので、ここセントついでから20円ほど上がってしまったんです。
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
They had a constructive and productive meeting yesterday and continued the conversation about how to lower costs for the American people across the country. We're not quite there yet, hence the conversations will continue, both at a staff level and certainly with Senator Manchin directly.
Still no deal on President Biden's spending package, but the House clearing a $2.5 trillion debt ceiling bill with little GOP support. Minority Leader Mitch McConnell saying the following: Democrats want to print and borrow trillion after trillion on their own, create even more inflation on their own. So as Republicans have made clear for months, they will have to own a debt ceiling increase as well. Bloomberg's Joe Matthew joins us now from Washington. The message pretty clear there, Joe. You own it.
That's right, you own it, and I guess you could say they fixed it in this case, Jonathan. $2.5 trillion. Imagine a world in which we're not debating the debt ceiling every 2 weeks and walking up on the fiscal cliff on a quarterly basis. We now live in that world. This goes through next year into 23. We'll check back after the midterms to see how that goes. I'll add the national defense spending bill that's expected to get a vote in the Senate today. This is a big one that we've been waiting for, and I will note that it does not apparently include, or will not, the Safe Banking Act, which would allow cannabis companies in this country to use banks, something that a lot of investors were betting on at the beginning of 2021. And then, of course, there's the big one, the president's social spending plan. $1.5 to $1.75 trillion is the top line that we've been talking about for months now, but it's very unclear what the path is going to be. President Biden just this morning said it's going to be close when he was asked if it could pass by Christmas. That is Chuck Schumer's hope, the majority leader. But we've got some wild cards here. We're not sure exactly what the parliamentarian is going to say in the Senate about what is allowed in the bill and what is not. And the ultimate wild card is, of course, Senator Joe Manchin, who, as we've discussed, met with the president this week, has yet to commit to this, and doubled down this week, Jonathan, on his concerns about spending and inflation, suggesting to reporters outside his office 2 days ago that he will be watching, just as we are later today, what the Federal Reserve has to say, Jonathan.
Joe, naturally, we gravitate towards the numbers. They've come down from north of $3 trillion. We're now talking about something potentially with a one handle. Talk to me about substance. Senator Manchin, what does he object to that's in that bill?
You know, it's interesting. He objects to some things that are not in the bill, and that is bringing us back to that CBO score from last week. He doesn't think the numbers add up. Remember, it wasn't that long ago he accused his fellow Democrats of playing a shell game here. He thinks the programs in this bill will outlast the timeline that has been written into the bill, expand this over the course of 10 years, for instance, and he sees the spending adding up to actually potentially threaten other social programs. We know that he was not a fan, for instance, of paid family leave. We'll see how that ends up, whether it's on the floor or not in this bill, and some of the climate provisions that he has had a lot of concerns with. If you go back to the memo, though, that he signed with Chuck Schumer at the beginning of the summer and was leaked a few months back, he has remained consistent on all of them, including his top line number, which could be fudged a little bit, but also his call to end quantitative easing. This is a senator who is obsessed with inflation and says he heard about it when he was home from people in West Virginia around the Thanksgiving break, not just gasoline, but food and all the other costs that we've been talking about here, top of mind for Senator Manchin as he tries to make a decision on this bill, John.
He might get what he wants a little bit later. Joe, thank you, sir. Joe Matthew of Bloomberg. Look out for Joe's show on Bloomberg Radio. Stand on, 5 p.m. Eastern Time, daily, Monday to Friday. That's the appearance fee for Joe Matthew down with Michael McKee. The end of QE, just around the corner for Senator Manchin.
Well, the end of the QE is going to come a little bit earlier if Senator Manchin is watching John and Tom and Lisa on the Fed special this afternoon. Here's what he's likely to see. The Fed, and this is the Wall Street expectation, is going to double the pace of tapering, $30 billion a month. That would get them finished by March. Maybe that makes the senator happy. Forecast for inflation is going to have to significantly increase. They thought it would be 4.2% this year back in September. It's already 5% when you look at the PCE, their favorite index. The dot plot. 2 rate hikes in 2022, 3 in 2023. You look at the dot plot, and the Fed was evenly divided for 2022. The bet now is they go up, but not as much as people think they should, because the Fed will want to make the point that it doesn't believe inflation's going to be out of control. And that brings us to the third thing that Senator Manchin's going to want to watch, and that's in the summary of economic projections. What do they think is going to happen with inflation? The white line is the PCE inflation that we're seeing, and those 3 lines are the Fed's predictions for 2022, 23, and 24. Are they going to have to raise those as they have been doing each meeting? You can see there, the purple line is the one that matters. That's 2024. That's the farthest out they go. It's just at 2.2%. Is that good enough for the senator from West Virginia, or is he going to have to see it even lower?
These forecasts have been terrible, Mike. 2.3 for next year, 2.2 for 23. I'm thinking about 21 at 3.7. As far as you're concerned, Mike, let's put a bow on this before we get together again a little bit later this afternoon. Has this been a shift in the reaction function or just a really bad forecast?
It's probably been a really bad forecast that followed the shift in the reaction function that put the emphasis on the unemployment rate. The Fed did not think that inflation was going to be as out of control or as high as it is. Now the question is, how fast does it come back down? They think it's going to come back down, and interestingly, so does Wall Street. The 5-year forwards
it's a good point.
Say the Fed's forecast for the longer term isn't that bad.
It's a good point. Mike, looking forward to the coverage later. Looking forward to being with you, sir, and looking forward to the news conference, which you will no doubt be a part of. Mike McKee there, coming up later on a Fed show. In your equity market, about 21 minutes into the session, we're down 1/3% on the S&P. On the NASDAQ, -0.6% with your sector price action. Here's Kriti Gupta.
Well, good morning, John. Some red on the index level, but you are seeing some upside movers. Healthcare towards the top of the leaderboard when it comes to a sector basis. A lot of that coming from positive earnings from Eli Lilly, and of course quite a poor study on J&J's vaccine that's saying it didn't have antibody protection against Omicron. That is helping Pfizer shares and boosting, like I said, the healthcare index. Big tech, though, dragging on the index. It is one of your downside movers, as well as commodities lagging. Energy there is your laggard. And speaking of those commodities lagging, a lot of those lithium movers in particular that have been gaining in light of that EV boom, well, they're getting some downgrades this morning. Goldman downgrading lithium producers Livent and Albemarle to a sell, saying those valuations just don't take into account supply and demand cyclicality. Now, John, those have been rising quite a bit all this year, and now it looks like some of that steam is being let out.
Kriti, thank you. Thank you very much. So what are we? About 22 minutes in, declining 1/3%, a third straight day of losses potentially. A game changer, of course, could come a little bit later from Chairman Powell. On the S&P, we're lower. On the NASDAQ, we're down 0.6%, a disappointing retail sales print. Didn't shake up this market too much. You wonder if it would have done if we didn't have this Fed meeting a little bit later. Your 10-year yield basically unchanged at 144. Your 2-year up about a basis point to, let's call it, 0.67%. From New York, coming up next, the market moving events you need to be watching. That'll be next in our trading diary with the main event just around a corner. From New York, this is Bloomberg.
Breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
'I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
"25 minutes in, your equity market down 1/3%, a slight move lower on the S&P 500 at least. On the Russell, the small caps -0.7%. On the Nasdaq 100 down 82 with -0.5%. All of this little decline going into the Fed later. Let's get to your trading diary. All eyes on the Fed today. A rate decision at 2 p.m. Eastern, followed by Chairman Powell's news conference at 2:30. President Biden speaking in Kentucky at 4 p.m. this afternoon. The Bank of England and ECB with their own rate decisions on Thursday. And finally, Fed Governor Chris Waller speaking on Friday to round out the week. Be sure to stay with Bloomberg for our special coverage. The Fed decides today at 1:30 p.m. in New York, 6:30 in London. You won't just hear from the chairman, a brilliant lineup of guests coming up a little bit later on. That will be my final show before Christmas. If I miss you, I just wanted to say a couple of words. At its best, this program is an ideas exchange, as my good buddy Guy Johnson out of London would always say. For a lot of that, I have to be very thankful to the guests, but also to you at home. You guys at home are what I believe to be the smartest, most engaged audience on the planet. You make me better at what I do, and for that, I'm incredibly thankful. So over the Christmas period, stay safe, hug your loved ones, and have a very happy Christmas.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it? Or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the quarter three was the quarter that was most affected.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive.
number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.